We have labor costs that are rising. That's going to show through to higher prices.
Andrew, do you think then we're still underestimating the persistence of this story and the resolve of this Federal Reserve?
I think that's always the danger, and we went through that a year ago last summer when we saw some softer prints, and I think there was a lot of optimism that maybe we could be seeing inflation that was actually transitory. And I think we just have to be really careful about not letting hope triumph over the reality of the situation. We all hope for a soft landing. Certainly, I would hope that's what the economy can achieve. There's a possibility of achieving that. You're going to hear Fed officials that emphasize that possibility, but it is a possibility. It is not a high probability. It's a possible outcome, an outcome that we hope for, probably not the most realistic outcome at this point.
Andrew, I won't ask you to get out the crystal ball and tell me where inflation is going to be 12 months out, 18 months out, but do you have a decent idea of what the threshold is for this Federal Reserve to take a pause, to look around and say, perhaps that's enough?
So one thing that's been useful is we've heard from a lot of Fed officials. We, of course, had Chair Powell speaking at Jackson Hole, just being really crystal clear about the resolve and the desire to bring inflation down. But then how do you operationalize that? We heard from Vice Chair Brainerd last week saying, I need to see several weaker prints, several softer inflation prints. And Fed speak, several means more than a couple. So we're looking at more than 2 months. With July and August data, we may see 2 months of weaker inflation. So I think it's a series of weaker, softer monthly inflation prints. And also, very importantly, that you see this broad-based. And I think that's part of the lesson of the last year or more of inflation data, is that you really have to look at what is the breadth of the slowdown. If this is just used cars, if it's just airfares, that's not going to be sufficient. What you want to see is services prices that are at least not accelerating, rents that are slowing down at some point, and we know house prices have slowed down. So there are reasons to think that you could see softer readings as we move into 2023, but clearly not seeing that yet. I think way too early for the Fed to declare victory on this.
That said, Andrew, from your vantage point, do you think, and I hate saying this because I'm going to get pilloried, but a soft landing looks more likely because of how much prices have rolled over, so much more than some people had previously expected?
Well, I think the issue, Lisa, is really what we were just talking about, is how broad is that decline in prices? We're talking about certain categories of goods, and that's maybe not that surprising given that we had really excessive demand for goods in particular. And now that that demand is moving and shifting a bit into the services sector, what I'm increasingly concerned about is upward price pressure for services. Now, we saw airfares that went up significantly. It looks like we'll come off of those highs, and we have come off of those highs. Maybe we'll see a decline again in that category in the report this morning. But that's really the question for me is, are we slowing down in a broad-based sense? If this is just gasoline prices, if this is just certain goods, I don't know that that's sufficient to really say that underlying inflation has slowed. And then even on the good side, remember, we're talking about shortages of energy, natural gas in Europe. We're talking about a potential railroad strike later this week in the US. So there's still some really acute upside risk to goods inflation that I think we should also be aware of.
Based on your projections and these granular components, Andrew, where do you see inflation ending next year? I mean, people are trying to game out the likelihood of getting down to a 6% handle or an 8% handle by the end of this year. What about 2023?
Yeah, so no question we'll still be very elevated at the end of this year. It really is 2023 where you look for inflation to come off further. When we forecast out that far, we see a path for headline inflation and various measures of core inflation to get down into the 3% range. I think that would be quite an accomplishment if the Fed was able to return inflation, which would still be above target, but at least closer to target around 3%. The issue is that it looks to us that to get there, you will need at least a somewhat significant rise in the unemployment rate. This idea that we're going to bring down inflation and cool wages. Remember, if you look at Atlanta Fed wage tracker, it's running at 6.7%. So we really have a lot of pressure in wages. It looks hard to us to see those kind of even 3% inflation numbers without a significant loosening in labor markets.
And if the dynamics and the behavioral movement from 8-9% inflation to 5% is a mystery, let's say it's nonlinear in some forms, the linearity that was invented by Alan Greenspan of a measured path We've almost become unmoored by that. How unmeasured are we right now? How unmeasured is our response to inflation?
Yeah, it's a great way of putting it, Tom. I think quite unmeasured in the sense that you have central banks that are trying to do two things, and this is true in the US, it's true globally, where on the one hand, or one component of this, is trying to just get policy rates up to a level that's more consistent with where inflation is running. You very kind of basic back of the envelope. You usually think policy rates need to get up around the level of underlying inflation. So you're behind in that sense. That's leading to larger hikes. But then there's a second issue, which is credibility. And you're going into these meetings as central bank officials with markets looking for what you're going to do, the public looking for what you're going to do. And it's the messaging as well as the actual policy action. And I think that's part of why you've seen, for instance, from the Fed, a string of 75 basis point rate hikes. It's to catch up to where policy rates probably should be, but it's also to try to send that message. So we had Chair Powell do that at Jackson Hole through his rhetoric. I think next week at the meeting, we're going to see Fed officials try to do that through their policy as well.
Andrew Hollenhorst, the City. Andrew, good to catch up. I know you're looking for 75 from the Federal Reserve next week. The problem often, and this is always the case, that you have a market focused on one thing and a policymaker looking at another. The policymaker is saying, look out at 2023. You're going to keep rates up there, going to be persistent about this. We don't want to lose them prematurely. The markets are just looking for the downshift from 75 to 50, from 25 to pause. And let's face it, are they going to get a signal of a downshift in this news conference next week?
Well, and if they do, what kind of economic pain has to accompany that? And this is Morgan Stanley's concept, which is what could potentially cause, I'm just going to ignore that, cause the Fed to move away from raising rates and actually lower them. It would have to be economic pain that they see actually causing a real problem, because it's unlikely to see inflation really get down to that 3% level in core that might make them a little more comfortable without that.
Going. I need my sausage roll now, my second breakfast. John, this parlor game of gaming rates up, and then we're also going to game at the same time when we turn around and reduce interest rates. This is a modern insanity.
It's increasingly frustrating, Tom, but it's happening.
It's ridiculous. Yes.
And ultimately, that's what the Fed is pushing back against. The Fed is trying to maintain tight financial conditions to bring inflation back towards something that looks like a trajectory back towards target. The problem is every time you get a sniff, just a sniff of some kind of soft landing, financial conditions start to loosen again, they don't tighten.
Yeah, and this is part of the problem, and this is a reason why we had people coming on and saying it's game theory, right? Didn't Jonathan Golub say that at Credit Suisse?
Yeah.
It was like, it's game theory. The Fed wants us to believe they're going to be hawkish, but they're not actually going to be hawkish. I find it interesting that over in Europe, you've got the ECB still saying they do not see a recession, and everybody else is doubling down on it. I mean, BlackRock's Wei Li, who's going to be joining us tomorrow, she actually came out yesterday with a note and said, yeah, there's going to be a recession. The energy costs are going to cause a recession here.
It's very, very difficult for a policymaker to forecast a recession and say those words out loud, because there's something self-fulfilling about a policymaker saying that. In fact, I think the only one that has done it out of all the major central banks is the one right here. In fact, Tom, the one just around the corner. It's the Bank of England and Governor Bailey. They're the only ones that have done it.
Are they just around the corner?
Just around the corner.
I did not know that.
You walk past there every morning when you come.
Is that the guy that waved at me today? Maybe he waved at me on the way over today.
You think Governor Bailey saw you?
I think he waved at me. I said, did I see you at Jackson Hole?
Did he remind you that the decision is next week, not this week?
Yeah, he did.
Good.
It's after the Fed, which is actually a big deal.
You had a chat. Futures positive 0.6%. CPI just around the corner. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Ukrainian President Volodymyr Zelensky is claiming success for his forces in that counteroffensive. Zelensky says Ukrainian troops have now recaptured more than 2,300 square miles in the east and south of the country this month. But Russian forces have hit Ukraine's energy infrastructure, leaving hundreds of thousands of people in the dark. Inflation in the U.S. probably slowed for a second month in a row, but that's unlikely to prevent the Fed from delivering another jumbo interest rate hike next week. In a Bloomberg survey, economists forecast an 8.1% rise in prices last month from a year earlier. The Consumer Price Index comes out at 8:30 New York time. Bloomberg has learned that the Justice Department has subpoenaed dozens of former President Trump's campaign operatives and allies. It's part of an effort to collect information related to the plot to overturn the 2020 presidential election. A lawyer for one of those subpoenaed, former New York Police Commissioner Bernard Kerik, calls it a fishing expedition. And the Twitter whistleblower who is warning of security flaws will take his case to Congress today. Peter Zatko's testimony could further complicate the legal battle between Twitter and Elon Musk. Musk is trying to back out of a $44 billion agreement to acquire the social media company. Zatko's testimony comes on the same day that Twitter shareholders are also set to vote on the deal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Policy, politics, from the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
We're in the camp that inflation is going to decelerate. They're going to raise rates by another 75, most likely in less than 2 weeks' time, pushing the funds rate to 3. That's in a 6-month period of time, 300 basis points off zero.
the head of America's fundamental fixed income at BlackRock, making the point that we've done a lot of work in a very short amount of time at this Federal Reserve as they play catch-up to bring inflation back down. Equity futures going into the CPI report, they're firmer this morning. They're firmer by 0.6% on the S&P. Yields are lower by 4 basis points to 3.17 on a 10-year. The euro stronger. Dollar weaker again. 1.0175 on euro. Dollar firmer by 0.5% on that currency pair. 4 days of gains on the S&P into Tuesday. Is that the winning streak now, Bramo? 4 days of gains, I believe, is the longest winning streak going back to early July.
Yeah, and some people saying it reminds people a lot of July because there isn't a lot of liquidity and not a lot of conviction, and it's not very loved.
A 5% rally, Tom, in that short rally.
Yeah, I think it's a short covering. Yeah, that's what's in the zeitgeist, but it's got to be more than that, John. But is it like June where you go up, you turn around, come right back down, or is there something different this time? And we'll have to
and
see
get
how
clipped
it goes.
around the head, around the ears by this Federal Reserve and Neil Kashkari.
Yeah, well,
and the Minneapolis Fed president who decides that perhaps this market shouldn't be rallying.
There's a lot of uber bears that are going, ooh, okay, that was harsh. Right now, let's look at oil. We do this with Regina Mayer, global head of energy at KPMG, steeped in all of the game theory of her Rice University. Regina, I want to focus on the game theory right now of President Biden in one chart I just saw in passing, which is our so-called strategic oil reserve. And the proper scientific word for this is the volume we have in reserve has truly cratered. What does that mean for America?
Well, I do think we've probably reached a tipping point where it's time to focus on refilling the Strategic Petroleum Reserve because it is at an all-time low. And I think we're sort of out of the woods from a U.S. energy price pressure that was driving inflation and the things that I know the politicians were worried about coming into the midterms, and that was the price at the pump. We see gasoline prices in the U.S. consistently go down and down and down. So I believe if anybody was taking my advice, it's time to start focusing on restocking our SPR and getting it a little above where it is today.
Can you get out the Kufalet or slide rules at KPMG and tell me how much a gallon of gas is going to go up as President Biden restocks that reserve? Are we going up 20 cents a gallon, 52 cents a gallon? What's that statistic?
No, actually, I think we're out of the woods on gas prices, Tom. I mean, I think that, you know, we're done with summer driving season. We've got quite a lot of stock. The refineries are up and running again. I'm less worried about what that would do immediately to gas prices. I will say that what the administration did with regard to releasing fuel from the SPR was one of the key things that the energy industry will say made a material difference in the summer peak season than when we saw gasoline prices at their peak in June.
Regina, that's a story over in the United States. You're in Portugal right now, in Lisbon, and we're in London, and the focus very much is on energy, and it's a very different and multi-pronged concern because it's not all gasoline or crude, it's natural gas, it's some of the issues with nuclear energy over in France. From your perspective, is the plan that's coming to shape from the European Union of trying to cap demand while also providing profits from the energy companies to households, does this make sense? Does it feel feasible to you?
Well, Lisa, I think that the EU's already made quite a bit of progress. So we have seen European gas prices drop. We're at a 7-week low, and it's 40% off its peak on August 26th. It's still 8 times higher than normal, but there are bright spots. Gas storage is up 84% right now, and it's slightly above where they would have expected to be for the 5-year average. The countries have been working on securing as much supply as possible. Now they're looking at packages to reduce demand and to cap what that would do to household income. It's going to cost a lot of money. There's got to be national budgets are going to be strained. So there's got to be a lot of different things that happen. I would not say they're out of the woods because if it's a particularly cold winter and if we see Asian demand start coming back in where cargoes of LNG are priced up in a competitive way, that's where things get really critical again. So not out of the woods, but the things that they have been doing in the near term are having a measurable impact.
Okay, so Regina, could you just build that out a little bit? A measurable impact in that we are seeing natural gas prices come down significantly. But is that impact going to lower them further as they are still 8 times higher than where they were a year ago? Or is it going to just keep them here, keep it just sort of a persistent crisis rather than something that is much more acute and immediately needing to be addressed?
Definitely. We're not out of the woods. And I think that the pullback in the recent days is probably over amplified with what's happening in Ukraine. I think maybe there's a little bit of irrational exuberance about what happened, and maybe some people thinking, okay, the war might be over and we can stop weaponizing gas. I don't anticipate that at all. So while the measures are important, and what I see the EU working on is a comprehensive package, because you have to work on both demand and supply, no doubt it's having a material impact, and it will have a material impact on the economy. I'm hearing from some executives here in Portugal that their energy costs are in some cases $1 billion over, right, what their expected energy costs are. All of that's going to have a material impact on earnings, competitiveness, and they're going to shut down factories because it's too expensive to run them.
We're already seeing that, and we could see it a whole lot more going deeper into winter. Regina Mayer there of KPMG out of Lisbon, Portugal today. Lisa, that's the problem for the Europeans. We've gone over it repeatedly. You're going to see a wave of industry shutdowns as we go deeper and deeper into winter if they can't tackle this problem. And I think it's unrealistic to expect them to be able to tackle this problem completely fully this winter. It's whether they can next winter or the one after that.
So it's not just an issue of curbing demand in the near term and trying to help households. It's also an issue of how do you build out the infrastructure? Where is that natural gas going to come from? And Anne-Marie yesterday was talking about how a lot of it's coming from the United States, which really creates new alliances and new needs at a time when there's questionable leadership in a lot of different places in the world.
And new complaints too. If the US consumer has to carry on paying high prices for nat gas and the Americans are exporting so much. One of the biggest complaints I've heard since we've been here in London and we've spoken to energy experts is the complaint around the lack of an effort to curtail demand in this country. That all we've had so far is a big effort, I say all because it's massive, from this government to support people's ability to pay the bills, but doing very little to curtail the demand.
Pro-growth, John. It's pro-growth. You just help them spend, and then you also borrow lots of money, and don't worry about budgeting the balance, like balancing the budget. And that's basically been the theme that we've heard, and a lot of people are saying it's different than what's going on in Europe.
Sure.
It's different than any kind of economic theory.
John, what does Tuesday look like after the funeral for this queen?
That's a hard time.
How does the debate click in Tuesday?
I think almost immediately.
I agree.
We've got to hear from this government and get some kind of statement on what's going to happen fiscally, and then we'll hear from the Bank of England. It's go, go, go.
And I would, John, take it down to our team coverage and team reporting here at Bloomberg Surveillance. Our entire team has been looking at the freshly cooked sausages, a pillow-soft white breakfast roll, plus a generous dollop of HP sauce.
Is this at Greg's?
2 price rises for the sausage roll at Greg's. Pence, I say. Pence.
Do you know how many of them they sell every week?
To me?
2 million plus a week.
Seriously?
Sausage rolls.
My favorite thing is he's looking up Greg's sausage rolls and trying to figure out how to weave it into here.
He's trying to find out how to deliver them.
There's a way to deliver them?
4, 3, 2.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. Katie Fogarty crossed over from a Wall Street analyst role to steer Shake Shack through a critical transformation.
Before, it was a lot of kind of sitting in an armchair type basis. Here, it is driving a plan of how we can best maximize shareholder returns.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
Depth of the recession which is looming right now is probably going to end up shallower than what we could have feared.
Both the consumer as well as businesses are starting to, at the margin, roll over.
It's still very clear that the global economy is in a very weak phase.
We've been the most surprised to see that the market is more optimistic than Fed commentary.
Clearly now, they have sent the signal that they are going after inflation first and foremost.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow with equity futures positive going into the CPI report 90 minutes away. Tom Keene is counting down in how many different languages?
I think 25.
2 or 3. I think in French he was counting up and not down.
Google Translate to the rescue.
How's that working out?
It's good. Google Translates. Work it out. Great. I am enjoying our more business focus today. We pause here within the morning for the Queen. And it was serious events today we don't need to go into right now, but it gives us the luxury of focusing, John, on what we do.
On the data in 90 minutes, and Lisa, that's front and center for all of us.
And a lot of people are wondering how much of a deceleration we'll see on the top line, which is the reason why the core is going to be that much more important. Basically, the other non-energy, non-food costs, how much are they increasing? And I think Andrew Hollenhorst put it beautifully, where he was talking about really it's all of the different components, and until you see a broad-based decline in the pace of inflation, it's not going to get the Fed's attention in terms of a pivot.
That's the story for 23. The pivot is a pause, or maybe it's even rate cuts if you speak to some market participants. We need to work out the difference between 50 and 75. Tom, they told us they talk about the totality of the data. Do you think today is the difference between 50 or 75 from this Fed?
No, I'm exhausted by it. And you know, John, I was exhausted by it months ago. I would suggest, folks, you look at the makeup of inflation. I'm going to go back to block and tackle, which is goods, service dynamics, basic stuff, the world of David Rosenberg. I'm not going to focus on the financialization debate.
Shelter costs.
Shelter,
Rents.
Yeah, killer.
Absolutely killer, as Tom said.
And they haven't really been rolling over. There's some areas where perhaps they're starting to plateau out, but that's not enough when you start looking year over year at some 12, 15% kinds of rate increases. more.
I don't mean to interrupt, but did you see home
not.
furnishings? I would never interrupt. But just something like, the Rosenberg subdivisions, John, they come out at 8:30. McKee looks at all this stuff.
Yeah.
And the answer is, one of them that I noticed is home furnishings is
notice
nuts. I just noticed, they had one of the beautiful artworks we have up. They look great on Bloomberg Radio. And home furnishings was a stupid number.
Do you know what I noticed this morning going into the CPI print? The weakness in the US dollar again.
Yeah.
To see sterling back at 117 when a week ago we were looking at 114, potentially 113. That's a big turnaround in the last week.
You're even seeing the Japanese yen strengthen just a touch.
Like kinda. Kinda.
I mean, kinda is actually notable considering it wasn't before.
Well, they'll take kinda right now.
They'll take kinda right now. And basically, this is really a story about disinflation and people getting excited about the potential. Maybe we've seen peak inflation.
Maybe, perhaps.
Anyway.
Kinda. Futures look like this on the S&P 500. They're positive about 6 or 0.7%. Going into the CPI report in around about 90 minutes. Yields are back in, down, lower, negative 4 basis points on a 10-year to 315. Bear in mind, at the front end yesterday, we came very, very close to 360. Lisa, then we backed away by a couple of basis points, and we're doing that again this morning.
Again, the disinflationary theme, that people's inflation expectations are coming down, and we did see that also from the New York Federal Reserve survey of consumers, which also showed inflation expectations falling pretty significantly. All right, we're looking today for the 8:30 a.m. Eastern U.S. CPI for the month of August, in case you hadn't noticed, as we've been talking about all morning. I am focused very much on the core, the non-energy, the non-food costs. How much have they really declined, plateaued? Which aspects of them we are going to be looking granularly. We're also going to be tracking the Queen Elizabeth's coffin, which is traveling from St. Giles Cathedral to Buckingham Palace, with all of the tributes pouring in and the royal family speaking and walking behind her. And at 1 p.m., we get the U.S. selling $18 billion of 30-year bonds. I am interested in this, even though Tom is not. I'm interested because this highlights what the demand.
While you were speaking about
I mean, it's happened before. It'll happen again. He did grunt, and that is going to be his response to bond auctions. And I will say this is a very interesting moment because the roll-off of the Federal Reserve balance sheet is gaining steam. So suddenly, do you get more concern on the part of investors about a lack of Fed put or a lack of Fed buying? And, how does that affect their involvement?
It's QT and not QE. I think that also has consequences for the fiscal conversation we're having here in the UK, across Europe for that matter as well.
Yeah, if you don't have that big buyer of that balance sheet, then how do you finance a lot of these fiscal spending programs at the same kind of rates that don't become infeasible and kind of reach those thresholds you were talking about
earlier?
Are you
looking forward to the auctions a little bit later, yeah?
I'm all over the auction. The surveillance snap is global, I should point out. You're going to
take the nap around that time.
Right there.
Really
Mona Mahajan joins us now, Senior Investment Strategist at Edward Jones. Mona, let's start here. A conversation about whether this rally we're seeing over the last 4 days or so is just the bear market rally we witnessed back in the summer. What is the difference?
Yeah, I think this rally is perhaps in part driven by the enthusiasm or anticipation of the number we're going to get at 8:30 a.m. today, which is a CPI print that will likely be below last month's. The headline inflation, as we all noted, likely to come down given what we're seeing in gas prices, oil prices, commodity prices broadly. All eyes will be on that core CPI figure. We all know that shelter and rent tends to be stickier, but we are getting an offset from lower airline fares, lower car prices to some extent. And so, we're probably poised for a decent number at 8:30 a.m., which, the story really for 2022, the rest of the year, is what direction of travel will inflation go? And the Fed wants to see not just one print lower, they want to see 2, 3, maybe 4 prints lower. Once we get that and we head towards year end and the Fed can pause potentially and financial conditions maybe start to ease and go in the right direction of travel, that's when we think we'll get a more sustainable rally. Until then, we do think volatility more likely.
Mona, you have a huge advantage with your representation of Edward D. Jones. They are nationwide. They are across the fabric of the nation. How crushed are the clients of Edward Jones by this unimaginable 8-9% inflation?
Yeah, look, there are several pockets of this country that are still suffering from elevated inflation. And you think about the segmentation of our retail clients, but segmentation of the population broadly. Clearly, those on the lower end of the spectrum, those that are living more paycheck to paycheck, are feeling this 8% inflation still to a larger extent. And that comes up in the grocery store bills, that comes up in the gas pump. But the good news is it's a very tangible move lower over the last few weeks. We're seeing it in gas prices at the pump. Even parts of your grocery store bill are looking a lot better. And so I think a little bit of optimism, and we're seeing that come out in the economic metrics as well when you think about inflation expectations not being anchored higher, in fact, moving in the right direction, again, lower. When you look at things like the ISM prices paid index for both manufacturing and services rolling over pretty dramatically. When you look at even the supply chain stress indices heading downward. So we think the momentum is moving in the right way. Things like a cooling housing market, a potentially cooling labor market, they will take more time to show up in the inflation figures. But we do hope to see that towards year end as well.
So Mona, are you all in on soft landing? Are you loading the boat on S&P?
Is that really the new phrase?
You know, I think soft landing right now, I think will still depend on, this is a still unprecedented Fed cycle here. Keep in mind, the Fed doesn't have a great track record. 11 of the last 14 Fed cycles ended in recession. This one, we're going up to a 4% terminal rate. We're going in 75 basis point increments. There was a lag impact from such dramatic Fed rate hikes to the real economy. We do anticipate a slowing economic momentum below trend for sure as we head towards year end. But I think the probability of a full-on recession still remains low. If we do enter a downturn, we still don't see the scope for a deep or prolonged recessionary environment here in the U.S.
Mona Mahajan of Edward Jones, we've heard that many, many times. Not the soft landing part, the short and shallow part. Mona, thank you. It's always great to catch up with you. We appreciate it. Tom, this soft landing, this whole argument, this debate, got fuel from the payrolls report a number of Fridays ago when the participation rate climbed, unemployment climbed, wages were softer, payrolls were still robust. That's just one data point and a whole host of data points that are speaking to this idea that maybe it can be executed. But I'll say this, and this is the important part. This is about the journey back down towards what, 5% on inflation? The journey from 5 back towards target, which is 2, is a very, very different effort. And what this Fed is basically telling you is that to convince us that we're on a trajectory back towards 2, and we don't want to prematurely lose it,
too far away.
We've got to get rates up and then stay there and wait. And then even if we've got the itch to think we're there, we've got to wait, and then wait a little bit longer.
The fear right now is that they're going to go back to the 70s. They will move too quickly to loosen up financial conditions, to loosen up financial policy, monetary policy, and then you'll get a resurgence because some of the dynamics haven't been healed. And this really goes to this question of understanding an inflation that is different than the 1970s, but feels much more pervasive and much more global than it has in a long time.
This is what Mohammed El-Erian wrote about, I believe, in the Financial Times a number of months ago, Tom. The risk of a flip-flopping Fed.
Chairman but you may not get a flip-flopping Fed.
Well, Chairman Powell is telling you, you that he wants to avoid that almost at all costs in that address in Jackson Hole a few weeks back.
I take great issue with the idea that American capitalism, American finance, and the people of America can't operate in a higher yield environment. They can. Like the 70s, no. Obviously, that was terrible. But to move up here to some form of neutrality and wait and monitor and see what happens is certainly doable.
The one argument against that, and Tom, I'm with you, the one argument against it, and I think this will resonate with Lisa a little bit more than perhaps you, is the debt load. It's the debt load, Lisa, the increase in the debt load, particularly on the sovereign, not just in America, but worldwide.
So the argument against that, and I've been going back and forth with a number of strategists about this, some people say it is crippling. There is too much debt to really withstand this. Plus, you have a lot of countries that are trying to borrow, right? On the flip side, that debt is with nations. It is not with households. And that is a big difference.
And that's where this short and shallow idea comes from.
Yeah, exactly.
Sure. In the next hour, Scott Clements is going to join us from Citi. In fact, Brown Brothers Harriman, I'll get that right. He's going to join us from Brown Brothers
in
the next hour at 8 a.m. I'm sure he's in the Citi in New York.
Yeah, there you go.
Thank you.
Anytime.
That was the perfect sec. Thank you. Futures are positive by 7 tenths of 1%. You've got to count us down in French, Tom.
Yeah.
To CPI.
Sausage thread. He's grunting again.
What language do they speak in Venezuela as we count down to CPI? That might be more apt. 8% is still a real number.
Yeah,
Let's be clear about that. Even if it's got a 7 handle today, that's a real number too. CPI, just around the corner. From London, we'll be talking to New York. There you go.
There you go.
This is Bloomberg.
Keep
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukrainian forces have recaptured more than 2,300 square miles in the east and south of the country so far this month. That's according to President Volodymyr Zelensky. He said Ukrainian troops are continuing to push forward. Meanwhile, Ukraine is appealing for more weapons to build on its recent success. Bloomberg's learned that Germany will provide $68 billion in loan guarantees for struggling energy companies. The money will come from a fund set up to help companies cope with the economic hit from the pandemic. Germany is at the center of Europe's energy crisis, and there's concern that there could be a wave of corporate bankruptcies. President Biden is trying to capitalize on a sudden stretch of positive economic news. His goal is to turn the Democrats' biggest political liability into an election year selling point. The Democrats' bid to retain control of both houses of Congress have been boosted by falling gas prices and signs that inflation may be easing. That latest inflation data comes out at 8:30 New York time. UBS plans to raise a dividend for this year by 10%. The Swiss bank also expects share repurchases will exceed a target of $5 billion for 2022. UBS is returning excess capital to investors after calling off the $1.4 billion acquisition of U.S. robo-advisor Wealthfront. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. Wall Street prepares for the latest read on inflation.
Things are moving. The news flow is extraordinary.
Will headline inflation continue to ease?
The totality of the data has been better than expected.
Very positive movement on inflation.
Instant reaction on Bloomberg surveillance.
This is a new era, and it is one of the most pressing concerns facing us.
And what it means for the Fed.
This inflation fever is breaking and economies keep softening.
They are on track, perhaps, for that soft landing.
Inflation in focus today on Bloomberg.
We are in sort of tipping point. For now, governments in general have been able to mitigate a lot of the raw impact of the rise in gas prices that may become more complicated as we get into 2023, sorry.
Jean-Marc there, the chief economist at AXA Investment Managers, as we count you down to the CPI report. In about an hour and 12 minutes, we caught up with Citi's Andrew Hollenhorst only 30 minutes or so ago. He's looking for a 75 basis point rate hike from this Federal Reserve at their meeting next week. Going into that CPI print and that meeting, we've got a rally in this equity market over the previous 4 days, amounting to about a 5% move on the S&P 500. Right now, futures high by 6 or 7/10 of 1%. Yields a bit lower. We're down by 4 or 5, negative 5 basis points to 331 on a US 10-year. TK, euro dollar, once again, dollar weakness. Euro dollar 101.82. And I can tell you on sterling, we're looking at a 117 handle through much of this morning.
Sterling in America this morning as well, with Dow futures up over 200 points.
Thanks
That's
for that,
a good
Tom.
sign.
That's useful. It's good stuff.
VIX 23 is there as well. It'll be interesting to see what the VIX does at 8:30. Right now, and most importantly, Maria Tadeo is in Brussels, and joining us here with a view of St. Paul's Cathedral, Lizzie Burden joins us back from Buckingham Palace as the ceremonies for the Queen move forward. Lizzie, I want to start with you, and it is the topic of the city this morning, and this is a new Chancellor of the Exchequer, and some would say a purge by the new Prime Minister. This is not equivalent in America. You've got a first-class guy out of Trinity, Cambridge, and LSE, Tom Scholar, who has been shown the door after 30 years of civil service to this nation. Let's first start. Why was Mr. Scholar shown the door in the trust purge?
Yeah, he's gone all the way back to Gordon Brown, Tom Scholar, #1 guy at the Treasury. But Truss is making a statement. She says that she's taking on the blob, the orthodoxy at the Treasury and the Bank of England. She wants to get rid of the abacus economics. So as one government economist...
You want her to define what an abacus is?
Just keep going. As one former government economist put it to us, it's a symbolic decapitation. This is showing that there's a new ruler in town. But it leaves a huge power vacuum at the top of the Treasury at a time when you've got double-digit inflation. And the worry is, yes, you're dismissing Tom Scholar, but what about all the other people in the Treasury who are the most employable in the civil service who will now choose to quit of their own accord?
Let's rip up the script. Your opinion on this?
Well, I think what Lizzie's explaining actually started with Boris Johnson on his way out the door. Do you remember that parting speech about the Treasury and their role and the job they've got to do? Feels like he laid the groundwork for them to follow on with Liz Truss and the new Chancellor.
But the thing about the Truss-Kwarteng relationship is that this will be actual alignment, unlike Sunak-Johnson.
Precisely, yeah.
And this is going to be the closest alignment since the Osborne-Cameron days. That's what Truss wants, and surely that's a good thing when you're in an economic crisis, right?
Well, we've been talking about
it. Depends what you want to do, Lizzie.
Well, it also depends on how much you support your economy and at what cost. And Maria Tadeo, I'd love to get the compare and contrast with the European, the EU plan for energy versus the UK plan for energy, which is to give aid in the UK to households and just borrow to plug the gap. Whereas in the European Union, there is a focus on curbing demand, directly targeting the demand and taking money from the profits of the big oil conglomerates. How much is this gaining steam? When is this going to get passed? What details do we know? Well, we're about to find out because this is happening behind the scenes in a meeting led by Ursula von der Leyen as we speak. But I think you really hit the nail there. It will be about taxation. They want to call it a solidarity contribution from some of these fossil fuel companies, also power generators that do not use gas. And then it's a story about demand destruction. And what they say here is that when supply is tight, but also very expensive, what you need to do is use less power. To me, the thing to watch for here is the percentage. What kind of reduction are they hoping to get? And also the obvious question is, how do you implement it? And it's very clear that police is not going to show to your house to see whether or not you're turning off the heat. And this is a story about the big European buyers, but also the big European companies. So I'm interested to see whether or not they want to play ball here and what is the incentive to get them to, well, participate in this demand destruction. And it's not just at any time of the day. They say they want to see it at peak times because this is when the bill comes at the highest.
I'd say it depends how long it goes on for before people start turning up and checking thermostats deeper into the winter, but who knows. Lizzie, the criticism that people have levelled at this government is that this government isn't doing what the Europeans are doing, which is thinking about curtailing demand. They've come out with a massive fiscal intervention in the last week. To complement that, do you expect at some point there to be some kind of policy to curtail demand around energy consumption?
Doesn't look like it. What this whole package is untargeted and not in any way asking people to turn off the lights. You know, as they are in European cities, we've still got all this unnecessary energy consumption, and that's the warning that Philip Hammond, the ex-chancellor, came on and told us about, because really it's a blank check, the UK's energy bailout. Javier Blas had a great column saying that it was, you know, it's the biggest short on the wholesale gas and electricity markets with no hedge. Because it is a blank check, and our documents that Bloomberg's seen say that it could cost £200 billion. So no, that is the major criticism, along with the fact that Truss has ruled out the windfall tax and it's going to rely so heavily on borrowing.
And perhaps it's not a one-off, given what we're hearing from the Chancellor.
Well, that's the other thing, is that it's uncapped, right? They plan to do this in perpetuity. Of course, we've been talking about this for a while, which is at what point do foreign investors say, yeah, we're out?
Yields up. Yields up and away.
Another way to say yields up and currency weaker.
Well, I wonder what this Bank of England governor thinks as well, going into the meeting next week. We've talked a lot, Tom, about the 75 from the ECB, the 75 we might get from the Federal Reserve next week. You've mentioned it, Tom, the day after it's the Bank of England's turn, and Governor Bailey.
I think each nation culturally is different, and the United Kingdom is radically different than the structures of Europe and America. It's a separate and discrete debate away from Powell, away from Lagarde.
Is this just the beginning, though, from this UK government? Elisa, the intervention last week around energy, some people might make the argument that reduces inflation in the short term, may allow the Bank of England to go a little bit more slowly. But if you are to believe what this Chancellor is about to do, along with this Prime Minister, with tax cuts and all the rest of it, then perhaps that's another reason for this Bank of England to go a little bit more quickly.
Especially when you add on to that the unemployment figure that we got earlier this morning, which is unemployment rates falling in the UK. It's the lowest since the mid-1970s. Now, this sounds like good news, but it's because people are just leaving the market. So that's a smaller workforce getting higher wages because there aren't enough people to fill the jobs.
I wouldn't bring this up, but I happened to wander by Brown's Hotel while I was eating dinner the night of Brexit, while John was doing 15 hours in a row on air.
True story.
But from Brown's Hotel, John, we haven't talked about Brexit. Is this a nation affected by Brexit as well as the economic
I'm so happy there's only 15 seconds left on the clock, and we don't have to talk about Brexit. Lizzie doesn't want to do that either. Lizzie, thank you. And to Maria Tadeo, thank you to you as well. We're about an hour away from a CPI report in America, with futures up almost 0.7% from London. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
The inflation report in America 60 minutes away. Live from London, good morning to you. Futures are positive by 0.7% on the S&P 500. A rally in this equity market continues to build over the last 4 days, higher by around about 5%. Higher again this morning by 0.7%. Yields are lower, backing away by 5 basis points to, let's call it 331 on a 10-year, 330.80 on a 10-year yield. The 2-year very, very close to 360 in yesterday's session. We back away from that across the curve. Yields are lower in the FX market once more. This is the theme of the last week for sure. All of that dollar strength still in there over the last year or so, but backing off. Dollar softer, weaker, negative against the euro. Euro dollar positive 0.6%. Tom, that's very close to
John,
102.
how do we rationalize a
180.
4200 SPX? I mean, we got so many people.
Not a million miles away.
Yeah, we're not a million miles away.
Sure.
And I just wonder into Q4. Remember Q2? We were all gloomed about Q3, and boom.
Then we rallied.
Better than
and then
good.
what happened? The Fed pushed
we went back again.
So we're going to ease financial
We're gonna
conditions
do it
into the
again?
Fed, and we're all going to be asking the question next week to see if Chairman Powell pushes back. And we'll ask a question, something along the lines of saying, is this an unwarranted easing of financial conditions relative to what you need to achieve to get inflation back towards target?
And I think the backdrop of everybody being all bulled up and then all bared up and then all bulled up, or at least more bulled up than they were bared up.
You're confusing me now.
I know, but the positioning is light. There is a lot of volatility.
Sure.
People don't love this, and I love how Bank of America wrote that this, how do you trade this rally even if you have no faith in it? Basically sums up where we are right now.
Is it good news, or bad news, good news that Mark Cabana's with us?
I think it's just good news.
It's just good news. Let's do that right now. We are certain it is good news to talk to someone so astute. Mark Cabana is head of U.S. rate strategy at Bank of America and writes brilliant, very terse notes about the moment ahead. Mark, what is the singular sentence of your research note this morning?
That the Fed is probably going to overdo it. We have seen them turn very hawkish with the labor market strength that we have seen. That has caused us to revise up our path for the Fed. We now think terminal, top of the range, be 4.25%. And we think that the Fed will try and stick to this higher for longer mantra, but they're going to see a softening in the economic data, and the tightening that they're putting in today will risk overdoing it in the future. And that's probably going to result in a recession, an increase in the unemployment rate to around 5%. And even though the Fed doesn't want to contemplate the notion of rate cuts in 2023 or 2024, the tighter they are today, the more likely it is that they're going to have to cut over that period of time. And we're about to get a reasonably constructive CPI print. Our economists are generally in line with the street. We think that we're going to see headline CPI move lower on a month-over-month basis. Core will be a little bit stickier. This is the type of inflation that the Fed needs to see. It's going to be the start of a trend lower in inflation. And as we're seeing the start of that trend, the Fed is sounding very, very hawkish. So again, we do see risks that the Fed overdoes it. We do see risks that there's a recession next year. And we do see risks that that's going to be a continued headwind for risk assets and markets more broadly.
Mike Gapin has penciled in that recession for next year. Do you have a decent understanding of where the threshold is for this Fed to pause?
Right now, it seems very, very high. And if I had to point to one indicator and one indicator only, I would point to the labor market. It really seems like the Fed wants to see a material softening in the labor market. They're probably somewhat cautiously optimistic behind closed doors that inflation will be moderating. Certainly, most economists anticipate this. Surveys of inflation expectations anticipate this. And the market, the TIPS market, also anticipates this. But the Fed probably won't trust that until they see the labor market soften more meaningfully. And it certainly seems like the Fed is dead set on ensuring that they get that labor market slowdown. And they're going to keep rates as high as it takes in order to get that. Again, that just increases the risks of a hard landing or a recession in the future to us. But I do think that their focus likely right now is somewhat singularly on the labor market. Certainly, that's where we have seen the stronger data over the July intermeeting period over really the last month or two. And that's probably what has caused them to shift their tone and sound even more hawkish in relation to the last FOMC meeting.
Mark, a lot of people are expecting the CPI print to be constructive, as you said, to be lower, not higher, and to give some sense that there is this disinflationary feel. How much of that is actually due to the tightening in monetary policy?
So we think that a lot of it has to do with lower energy prices. And I heard you earlier on this program talking about the very important distinction between headline drivers, goods drivers, and services drivers. And so we think that the Fed wants to see just a little bit more of easing on the services side. Lower OER, lower inflation in reopening sensitive or travel sensitive sectors in the economy. That's what we think they're going to be looking for. Now, no doubt the tightening of financial conditions that we have seen is playing a part of the broad economic moderation that appears to be underway. But really, if you look since the last FOMC meeting, financial conditions are a bit tighter, but I wouldn't say that it's notable by any stretch. And I do worry that this is a Fed that wants to see even more tightening of financial conditions in order to have faith that they will be able to achieve their 2% inflation target. Certainly, we think that the risks are skewed in the Fed continuing to sound hawkish and that continuing to be a headwind for risk assets.
Another way to translate this might be they want to see stocks go down a little bit more to give them comfort that perhaps people were buying their message. There is a question of how long it's going to take for the full effect of the tightening to really be borne out in markets, in the economy. And this is something people have been talking about, that by the time they start seeing the effects, it'll be too late to really turn around too quickly. How much will the runoff of the balance sheet quantitative tightening, which is accelerating this week, really turbocharge some of those effects?
Yeah, it's a great point. Certainly, you're right. We are seeing the Fed tightening really kick into high gear here with broad-based expectations for another 75 basis point rate increase at the September meeting and the increase in the balance sheet runoff up to its maximum amount where caps are $95 billion a month. Now, to date, we don't think that QT has had much of an impact. And we are still somewhat cautiously optimistic that over the next couple of quarters, the QT impact is not really going to be particularly heavily felt by the market. And a part of this reason is because we do think that there's just excess liquidity in the banking system. Banks are still holding a lot of excess unwanted deposits or excess unwanted reserves, and QT does help them get rid of those deposits. So the early stages of QT, we just don't think are going to be that consequential. But by the time we get into the first half of next year, maybe Q1 of next year, we do think that you're going to start to see more bank deposit competition. That's going to be driving short-term interest rates modestly higher, and that's probably going to bite a little bit more. So again, we do think that QT matters. It's just going to probably take a little while before it really starts to bite.
Mark, I want you to help John Farrell here. He's doing the real yield from LHR here on Friday on the way out. I don't know if it's Terminal 5 or Terminal 2, but it'll be a great view of a buoyant Heathrow Airport. Right now, we've got a nominal yield moving, and the partial differentials to the break-evens is stunning. There's an inertial force to the break-evens, which borders on act of God. What does that signal mean of lower break-evens right now to your world?
It means policy mistake. Again, the Fed is tightening in anticipation that inflation will remain persistent, and they feel like they really need to be aggressive in order to bring it down. But it strikes us that certainly the TIPS market is not reflecting elevated expectation of runaway inflation. If anything, the TIPS market continues to believe that the Fed is credible in its fight on inflation. And it's not just the TIPS market, it's also inflation expectation surveys. We saw that clearly in the New York Fed surveys, 3-year ahead expectation yesterday. Inflation expectations are declining as the Fed ramps up their hawkishness. So what that is doing in the rates market is it's causing real rates to rise. And it's really that real rate rise that matters more for the broad set of financial conditions. Look, if interest rates are rising just because inflation is elevated, that should have a fairly limited impact on broader financial markets. But if real rates are rising, that has a much more meaningful impact. It packs a heavier tightening punch into markets more broadly. And that is what we are seeing. And the higher real rates rise, then the greater the potential is that the economy starts to show signs of moderating and that financial conditions will continue to be tight or that financial conditions will continue to be challenged. And again, it seems like that's what the Fed is going after. We do worry to some extent that the Fed is going to go too far too fast. And we think that the 2-10 curve is going to become more inverted as a result of this. And again, we do think that the more tightening they do today, the greater the risk that they will have to cut tomorrow. And again, it is somewhat ironic in this higher for longer mantra that the Fed has been pushing for. But again, this aggressiveness today really increases the odds in our view that the Fed will be cutting in late 23 or in 2024.
Mark, real yields higher then. When you speak to the rest of the team, have you been surprised by, say, on the equity side with Savita, that this hasn't led to lower equity markets in a material way? In fact, they're rallying again, and it hasn't led to wider spreads.
Yes, we have been somewhat surprised by that. Now, look, a part of this may be due to positioning. A part of this may be due to an expectation that inflation will moderate and that will allow for the Fed to pivot a little bit sooner, kind of, very similar to what we saw in the early summer and some of that that equity market rally and credit spread performance. And again, if financial conditions continue to remain around these levels, then it just makes a risk that the Fed needs to feel like they have to tighten by more and front load it in order to try and get that sustained tightening of conditions in order to slow the economy and to bring down inflation.
Hey, Mark, fantastic. Just a bit of a clinic there as well. We appreciate it. Mark Urbana there of Bank of America Global Research. Lisa, that's the tug of war between the equity market bulls and what this Fed wants to see.
That basically, the more that equity markets shrug off the Fed, the more the Fed's going to tighten the screws. Yeah, exactly. And that's basically at least what they're doing in the rhetoric, maybe perhaps in the action too.
You love this, don't you, Tom?
Oh, it was great. I thought Cabana was great. At 8:30 here in 45 minutes, I'm looking at the Bloomberg Financial Conditions Index, which the last couple of days has pushed against where Chairman Powell wants to go.
Jay Bryson, Chief Economist at Wells Fargo, is going to be joining us. As Lisa said, look at the S&P.
I look at the
There's
Dow.
a man called Neil doing that, isn't it?
There it is.
I think he is. Yeah.
Dow's up 200 points.
Futures on the S&P.
Neil Kashkari for those.
Up 0.7%. It's not necessarily who I meant. Maybe I've got a buddy called Neil. Equities up. I don't. This is Bloomberg.
Thank you. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukrainian President Volodymyr Zelensky is claiming success for his forces in that counteroffensive. Zelensky says Ukrainian troops have now recaptured more than 2,300 square miles in the east and south of the country this month. But Russian forces have hit Ukraine's energy infrastructure, leaving hundreds of thousands of people in the dark. Inflation in the U.S. probably slowed for a second month in a row, but that's unlikely to prevent the Fed from delivering another jumbo interest rate hike next week. In a Bloomberg survey, economists forecast an 8.1% rise in prices last month from a year earlier. The Consumer Price Index comes out at 8:30 New York time. Bloomberg has learned that the Justice Department has subpoenaed dozens of former President Trump's campaign operatives and allies. It's part of an effort to collect information related to the plot to overturn the 2020 presidential election. A lawyer for one of those subpoenaed, former New York Police Commissioner Bernard Kerik, calls it a fishing expedition. Bloomberg has also learned that Bayer has quickly started the search for a successor to CEO Werner Baumann. Now that raises the prospect that Baumann could leave before his contract expires in 2024. He has survived plenty of shareholder frustration and legal turmoil since becoming CEO in May 2016. Baumann spearheaded the costly acquisition of Monsanto, which has been a huge legal headache. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the Amazon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
is a lot of momentum still in the core. I think that this one reading is not going to be enough to dissuade the Fed from a large movement at its next meeting, even if it is a bit softer.
Team 75, Stephanie Aronson there, Director of Economic Studies at Brookings Institution. She wasn't specific about being Team 75. Andrew Hollenhorst of Citi was, though. He joined us in the last hour. Going into that CPI report just around the corner, 8:30 Eastern time, which isn't too far away, Tom. Futures are positive by 0.7 to 1%.
75 basis points, that's a good statement on a buoyant and strong America, right?
If it remains buoyant and strong.
Thank you.
As you know, and we've discussed it a million times, if unemployment starts going the other way a little bit more persistently, then I imagine the balance starts to change.
We're going to change our dialogue here right now. This has been a day where we've moved away from the ceremonies for the death of the Queen of England, but we do so with King Charles III in Ireland. The distance from Belfast in Northern Ireland to Dublin is 103 miles, but across the centuries, it is substantial. Giving us perspective today on the watch in Paris, and of course his Ireland, is Stephen Carroll, who joins us from Bloomberg News to discuss the moment for King Charles III. What did Brexit do to King Charles, Northern Ireland?
Well, I mean, to the island of Ireland, Brexit changed the relationship across these islands, some would argue irreparably. It had been a reasonably stable, reasonably positive relationship, particularly since the visit of Queen Elizabeth in 2011, which for many was a high point of Anglo-Irish relations. It's hard to imagine that a monarch would have gotten up in Dublin Castle and opened her speech in Irish with 4 words, Uachtaráin agus a Córide, President and Friends, in a language which many had seen that, of course, historically the English didn't favour in their relations with Ireland. Brexit changed the game because you now have very different trade relations with the way that Northern Ireland functions. They're a special place within the post-Brexit relationship with the European Union. They're still in the European Union's single market. Trading rules with the UK still a complex issue and something that we know that Liz Truss as Prime Minister has focused on as well. And it is a question now, the question of Irish unity is back on the table since Brexit in a way that we hadn't seen before, because the relationships have been cemented on the island of Ireland. This is a matter that is left to a referendum. A referendum is the discretion of the British government here in London to grant to Northern Ireland. But it's a question being asked more now than it ever would have thought had been before the referendum.
You studied with the great Italian at the University of Chicago, Luigi Zingales, who's wonderful on American capitalism. How do you define Irish capitalism?
Well, Ireland has a very close relationship with America. If you think of all the tech companies that are in Dublin, it's the European headquarters.
Are they there just because of a tax dodge?
I mean, if you ask them, they say no. The Irish government's argument has always been that they were transparent about their low corporate tax regime, 12.5%, and they
Where did that go with Yellen? Did that drift away?
The minimum tax story?
The minimum tax
It's still underway. It's a debate that they're hoping to reignite at a European level now, because it does seem to have gone off the radar. They've been trying to package it into some of the major legislation in the US as well. It's still an effort led by the OECD in Paris that they're trying to create the structure for this. We know that France has been pushing very hard for it, and it was a really big step for them to get countries like Ireland on board with the idea of a minimum corporate tax. And with Pascal Donoghue as head of the Eurogroup, the group of Eurozone finance ministers as well, that's something they had agreed on the principle of both the profit shifting element and the minimum taxation element, but something that still there isn't political agreement everywhere about. And the whole argument of the OECD is you need a global deal for it to be effective, so that one country can't try to outbid the others.
The focus of this king today is on Northern Ireland. Can you talk to us about the popularity of the monarchy in Northern Ireland?
I mean, it's probably the one place in the United Kingdom where the monarch isn't necessarily going to be universally welcomed, although relations have improved significantly over the years. I spoke about the Queen's visit there in 2011. This is Charles's 40th visit to Northern Ireland, of course, only his first as monarch. And it's interesting because it is the first time that there is a Sinn Féin, so somebody from the Republican tradition, who is First Minister designate. There is no active government in Northern Ireland at the moment for their own political difficulties. But the idea of having somebody from Sinn Féin who stood up in the Northern Ireland Assembly last week and paid tribute to Queen Elizabeth as the courageous and gracious leader. Now, Sinn Féin didn't attend the accession event that was held in Northern Ireland. They said that was people who were loyal to the British monarch. But Michelle O'Neill, the First Minister designate, is meeting Prince Charles and the Queen Consort today in Northern Ireland, and that's something that represents the relations that are changed over the years.
And the troubles with respect to the lack of government in the region, and the question around unity has been a theme for us throughout the past couple of days. Can this monarch be a uniting feature at a time when there is that kind of skepticism? Or do you think that there will be this feeling, this desire for some sort of continuity enough to give people a little bit different of a perspective?
I'm not sure that the Queen as a uniting figure ever held that much sway in Northern Ireland, although the efforts that had been made in recent years with the number of visits being made by the Queen to Northern Ireland had sown the seeds for a positive relationship there. It is going to be a challenge for Charles in the same way that uniting relations with Scotland is a challenge as well. He is somebody that has a relationship with the place, and I think that's something that will stand him in good stead, but this is a political matter that's really outside the realm of the monarchy as well.
Stephen Carroll, fantastic to see you in person as well. Thanks for being with us. We appreciate it. Thank you very much. Tom, another phase in the sequence going forward to next Monday.
Well, to next Monday in the funeral service, Mr. Biden will attend, but I would prepare, John, besides the hundreds of thousands scheduled to walk by the Queen's casket, I would prepare for something equivalent to what we saw in 1963 in the United States. This should be an extraordinary turnout of world leaders.
Overwhelmingly so. Yeah. Lisa, you and I went through Westminster and onto the Palace over the weekend. Can you imagine how much busier it's going to be on Monday? Because London right now, it is packed.
It is packed, and they have brought in, I think, 10,000 police officers to London and a number of troops as well to try to have crowd control. And I love the article in the Wall Street Journal about the Royal Guard saying, please stop leaving Paddington Bears at Buckingham Palace because they're not compostable, and people continuing
That's problematic.
To Paddington Bears.
I would say rather selfishly, the football is getting cancelled. A lot of these games are being cancelled because of the police resources.
Yeah, exactly.
You mentioned the resources. Tom, a lot of these football matches can't go ahead because it takes away so much.
The public supports
that, right?
Yeah. I mean, they understand.
I think some people would like to see these games go ahead so that some of the fans could pay tribute to the Queen, because some sporting events have continued.
But they will starting next Tuesday.
Of course, they'll be delayed. Then we'll have to squeeze in a load of games going into the World Cup, but, there are more important things. I'm not here complaining about it.
So we won't be able to go to said games, which might also factor into your
said games.
Did I say anything about that?
Absolutely
Didn't say anything about that.
I'm just putting words in your mouth.
CPI, so important. It's just around the corner. It's 35 minutes away. Perhaps not. Inflation. 8%, whether it's 7.9, 7.8, this is still a big number.
As we heard from Mark Cabana talking the Bank of America line, this is about parsing away from the financialization, parsing services and goods inflation. And to see services inflation come in a little, as Mr. Cabana mentioned, would be a huge deal.
The word, I think, at the moment is persistence, and that is a story for the energy story. That is a word we can use for the Federal Reserve as well, and inflation. How much of this will persist? And that's why we need to discuss shelter at 8:30 Eastern.
And not only shelter, but also employment. When you take a look at the restructuring of the labor market, how much of that's going to be sticky with people demanding higher wages and not coming back to the workforce as quickly.
Where does Scott Clemens work?
Brown Brothers Harriman.
Not City.
But it's in a city. But it's in a city.
It's in New York City. Fantastic. Trying to get it right, just to make sure. Scott Clemens is coming up from Brown Brothers Harriman. He's going to join us very, very shortly. We are 35 minutes away from inflation in America, looking for something in and around 8%. The focus of this market will be on core, month on month. We'll go to that in just a moment. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. Katie Fogarty crossed over from a Wall Street analyst role to steer Shake Shack through a critical transformation.
Before, it was a lot of kind of sitting in an armchair type basis. Here, it is driving a plan of how we can best maximize shareholder returns.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
In the last 2 weeks, we've really seen an influx of risk-on behavior.
It's possible that global inflation continues to push higher.
We're in the camp that inflation is going to decelerate. Growth is going to decelerate.
The Fed is going to need to see a real slowdown in the labor market.
In a way, we are just changing the timing of the pain.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from London for our audience worldwide. I believe it's good afternoon now. In London, at least. Good morning to you stateside on Bloomberg Surveillance Live on TV and radio, counting you down to a CPI report about 30 minutes away, with futures positive 29 on the S&P, up 0.7%, TK. We build on this rally of the last few days.
Well, the rally is anticipating inflation that is quiescent. The magnitude is the word here. What kind of magnitude do we get in the headline data, the core data? But, John, I would go beneath the headline data. I will go right away to the David Rosenberg world of goods and services. That dynamic is critical.
The media, as we often do, may well go with the headline year-over-year figure, Lisa. That's often the bigger figure. That's why they go with that number. The market, Wall Street, to Tom's point, very focused on month-over-month core inflation, just to get an idea about the more recent trend.
I think you can go even further than that. It's not just going to be the headline core number. They're going to be looking at housing. They're going to be looking at wages. They're going to be looking at, to Tom's point, services. They're going to be looking at the granularity of each component and the stickiness in different sectors, because that's going to possibly be more interesting than even the headline either number.
And when they take in the totality of the data, because that's the word they've been using going into the Fed decision next week, is it going to be 50 or 75? I'm only doing this to wind up Tom.
Okay.
50 or 75?
And I'm going to wind him up even further as he sits there and he starts grunting. It's 75. I mean, pretty much everyone is saying that. Fed officials came out, they said it's 75.
I mean, if they came out and did 50, that would be viewed as incredibly dovish, even though it's a massive hike from any historical perspective.
And that's what the market is focused on, Tom. Some participants, anyway, the potential for a downshift from 75 to 50 to 25 and then to the pause through next year.
I'm going to move on. Let's say it's 75, whatever it is. I'm going to go to November. No, I'm going to move to November and into 2023 of the guesstimate of where neutrality is. I'm going to editorialize. We have no clue.
What did Mark Cabana say of Bank of America on the guesstimate of next year? Mike Gapin over at Bank of America is now saying recession for next year. Mark Cabana is talking up rate cuts, but rate cuts after the fact, because he thinks the risk now is the Fed takes it too far.
He's talking about unemployment having to rise. And this is sort of the conundrum, because if you get rate cuts, it's because there has been pain that you haven't necessarily seen priced in. This is the Mike Wilson view over at Morgan Stanley. Here come the earnings revisions downward, that's going to be what drives the next leg lower in the S&P because of exactly
Can I state it could be revenue revisions lower? Because if you do get a vector of inflation lower, all of a sudden a normal 4% grower that's up 7% grower becomes 5.6%, and that's at marginal move in revenues.
The only counter argument to that, and I don't mean to just cause trouble,
but you are
by all means cause trouble.
Is that you're going to see margin compression if you start to see wages continue to go up. Basically, consumers pushing back on those prices, demand destruction because of the inflation, which we've seen in
I'm not focused this morning. Mrs. Keene's visiting with me, and do you know she's over at the Tower of London picking out a room for me?
What is she doing?
She's picking out a room for me.
Are you in trouble?
I think I'm in trouble. She's at the Tower of London.
Sounds like you're in trouble. Let's check out the prices.
Let's do that. Where's the Dow?
The CPI report. No idea where the Dow is. Can I tell you where the S&P 500 is, though? Higher. I imagine the Dow is too. We're up 28 on the S&P. We're higher by 0.7%.
But not to the Dow.
It was almost. I mean, that's as far as I'll take it. You mentioned Mike Wilson. That means I've got to mention JP Morgan and Marko Klanovic.
Please.
Him and the team are basically saying we can achieve this soft landing. It's much more about the data than it is about the hawkish central bank rhetoric. What do you make of that?
Really?
Yeah, sure.
Okay, so Marko Klanovic, you can laugh because he's the perpetual bull. I can laugh, but at the same time, you could argue that I'm perpetually bearish in my outlook. So, it takes one to know one. And
you admitting that?
Well, I mean, it's not that I'm bearish. It's just that, it's sort of...
You're realistic.
I'm realistic and a little bit of, skepticism of the common party line, which is just sort of a nature.
Healthy dose is welcome.
Okay, not about me. Moving on. The point is, really, though, about a soft landing, it's not just him. A lot of people are saying that it's looking more likely because of this deceleration in inflation, as long as you keep it going past that 4% level.
It's never about whether things are good or bad for markets. It's about whether they are better or worse. And based on the incoming data over the last month or so, I think we can make the argument they're getting better and not worse.
Right, and it is multifaceted. It is airplane tickets. It's also some of the surge that we saw in cars coming off. Now the question is services. Now the question is some of these other components.
I think the big question socially, linking into all this mumbo jumbo you two are spinning, is OER.
Thank you, Tom.
I love you, Tom.
Is OER. Is real estate, real estate, real estate. That's a huge part of our monthly budget.
I love that you called what we're talking about mumbo
I don't
jumbo
agree with
and came
that.
out with an acronym.
I'm with Klanovic, and that corporations will adapt.
Shelter.
The nation will adapt. I'm with Bullard.
I'm aware.
Bullard's front-loading this.
Yeah.
Bullard is front-loading it to get out front of whatever comes our way, and this is an America that will adapt to these shocks.
I can tell you Scott Clemens has things to say. He's going to join us now, the Chief Investment Strategist at Brown Brothers Harriman. Scott, what are you looking for, sir, in 25 minutes?
I think we're going to get further evidence that inflation actually peaked in June. And I think it was Lisa who put her finger on it right at the top of the hour. But what's really important is the ingredients of the report, more so than the headline. Are we continuing to see relief, particularly on the goods and services front, in addition to what we're anticipating is more relief in food and energy, and we're seeing that in the underlying commodities market. Probably more important than any of the numbers will be the narrative the Fed wraps around it, because that'll provide some insight into whether or not the Fed is contemplating, dare I use the word tapering, in November and December to step back to a 50 basis point, 25 basis point hike with a view towards being done with this tightening cycle by early 2020. So all the English majors are going to parse the Fed's commentary next week, probably more so than the econ majors look at the numbers on the top line.
Scott, I know Brown Brothers Harriman took a meeting at the Langthorne Hotel in Regency, England, and it was the same debate in the 1830s as it is now. You can't pick the bottom. but when you do go up, you always have too much cash. Are we overburdened with cash right now as we invest for 2025?
Well, our clients are pretty fully invested in cash, although I will recognize that investors in general are very long cash. For longer-term investors, I would consider that a contrarian indicator. It doesn't work on a day-to-day basis, but in terms of unspent fuel or dry powder or assets on the sideline, characterize it however you want. I think that is fuel for the markets as and when the narrative begins to improve. And if we actually get some increasing relief on inflation, and if we get increasing confidence that the Fed is closer to the end of this tightening cycle than the beginning, there is plenty of cash out there to put behind that improving sentiment.
So are you bullish?
Lisa, I would say we are, but you have to take that into the context of a longer-term view. That's not a statement about September returns or even, between now and the end of the year. But we're looking around at a lot of opportunities in equities that have been unfairly pushed down with the rest of the market, particularly in the first half of this year when it was sort of a risk-off, sell everything that's not bolted down. So I hesitate to use the old cliche, but I'm going to use it anyway. I do believe that we're in a stock picker's market, and there are plenty of opportunities for people building portfolios for the long run. That's an investing comment. That's not a trading comment.
Can you tell us what stocks you're picking, Scott?
We keep those a firm secret, Jonathan, although I will say that we're finding a lot more opportunities in the mid-cap and small-cap domestic space. I'm going to do that economist thing and wave my hands and say, in general, those smaller companies are more geared towards domestic economic activity. We have more confidence in domestic economic activity than outside the United States. And they are less exposed to the strength of the dollar, which I think will be one of the big stories as third quarter earnings reports begin to come out.
Scott, wonderful to hear from you. Scott Clemens there of Brown Brothers Harriman. That final point on small caps is an important one. What are the two things you want to avoid internationally right now, until more recently? One's the strength of the dollar, that translation effect, back from a foreign currency, back into the US. And the other is just the weakness associated that with the revenue generation abroad anyway, given the difficulties in China, the difficulties in Europe.
Yeah, and add to that, Lori Calvasina has been out front on this from RBC Capital Markets saying that these have been the stocks most beaten up, and they are the first to start recovering, even in a recession, but before the next cycle. So that's the other reason why some people are saying small caps.
Always the way, isn't it? Stock pickers market, then you ask for stock picks and you can't
talk about it.
Get any. It's always about active management, Tom. Have you noticed
It's Ben Layler. In the last month, John, Ben Layler with a brilliant summation of the failure of active management. It is stunning, the math.
Well, the more you hear about it, though, Tom, based on the moment we're in, the argument is this is the moment, and maybe things have changed.
Okay.
If you believe, let's just take the mechanics of the index, based on the large weighting on the S&P 500 to growth names, big tech, and if you believe that real yields are going to be a persistent feature of this regime into next year, some people will struggle to make the argument that the index is where you want to be.
This is important. If you're running an index fund and you're working it off the Dow, there's some interesting peculiarities there.
Okay, well, so Tom is trying to tweak you, just to translate to everyone, because John, you are trying to tweak Tom because you know that this is his third rail is active management and the whole question of that. I do think that, to your point, factor investing has been catching on.
Yes.
Just the sort of merge both of you, right? Because there is this question.
Are you making sure we're getting along?
I'm just trying to play the, conciliatory part. You guys are on the the same page.
Yeah, we're codependent.
Something like that.
Why have I been trying? Who's passively allocated to the Dow? How much money is passively allocated
on the Dow thing? I don't think that the
Dow ETF?
I don't adhere to the Dow situation.
Coming up.
How you doing?
I'm great.
John and I are just, for those of you on radio, John and I are just sitting on the other side of St. Paul's Cathedral. That's all there is to it.
Future's positive, 0.7%. We're going to talk about OPEC's latest report with Christian Malik of JP Morgan very shortly. CPI is 20 minutes away.
Thank God for that.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. We'll get the latest inflation numbers for the U.S. less than 20 minutes from now. Inflation in the U.S. probably slowed for a second month in a row, but that's unlikely to prevent the Fed from delivering another jumbo interest rate hike next week. In a Bloomberg survey, economists forecast an 8.1% rise in prices last month from a year earlier. Ukrainian forces have recaptured more than 2,300 square miles in the east and south of the country so far this month. That's according to President Volodymyr Zelensky. He said Ukrainian troops are continuing to push forward. Meanwhile, Ukraine is appealing for more weapons to be built on its recent success. Deloitte is forecasting that U.S. retailers will see slower sales growth this holiday season because of inflation. The consulting firm expected a 4 to 6% increase in holiday sales. Higher prices are expected to drive more consumers online to search for deals. A Chinese-made single-aisle passenger jet designed to rival Boeing and Airbus could be certified by the nation's regulators this month. That's according to local media. Certification would clear the way for the C919 to start commercial flights some 14 years after development began. And UBS plans to raise a dividend for this year by 10%. The Swiss bank also expects share repurchases will exceed a target of $5 billion for 2022. UBS is returning excess capital to investors after calling off the $1.4 billion acquisition of U.S. robo-advisor Wealthfront. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Connection lost.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. Politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Has really shifted its viewpoint from inflation can't just be better than expected. Inflation has to be on an absolute basis lower. And we think that Chair Powell and others have had the chance to reset expectations away from 2%, but they really held firm.
Calmer show this afternoon. I can't decide if people are exhausted or happier. Lisa? Happier, sure. Eric Friedman, Chief Investment Officer at US Bank Asset Management. I'm not going to let you answer that, just in case. Equity futures, positive 0.7% on the S&P 500, with CPI just around the corner, 12 minutes away. Yields are coming down, lower, negative 6 basis points on a 10-year, just a break of 330, 329.85. And once again, what you're witnessing this morning is what you've seen over the last few days, which is some dollar weakness. Dollar index down 0.5%, weaker dollar. Euro dollar positive 0.5%, 101.72. I think cable, Tom, in and around 117. Crude positive 1.6%, getting closer and closer back to 90.
Markets churning here, and again, as John mentioned earlier, I believe it was John mentioned, the monthly inflation data will be of great interest here in a good 11 minutes as well. This is not only our conversation of the day, but our conversation of the week on oil. If you have a fear of $150 a barrel, it has been outlined in a blistering 100-page memo by Christian Malik, Global Head of Energy Strategy at JP Morgan Securities, a good 6 months ago. Yes, the price is cut away from those fears, but the underlying fundamentals exist. Christian Malik, the decrease in hydrocarbons that we've seen, is it just simply an Asia and a COVID flat on their back?
Absolutely. In some ways, there's a sort of two-pronged story here. You have, on one hand, a slowdown through lockdowns and some bumpiness in terms of the trajectory on demand and the sort of post-COVID sort of renormalization. But on the other hand, what you're seeing is a lot of volatility and uncertainty continue to exacerbate the supply outlook, meaning that most companies that ought to be investing in future production, particularly the majors, are not. So essentially, we're kicking the can down the road in terms of a tightening of the fundamentals. In the meantime, potentially just enjoying, probably not the best word, but ultimately taking advantage of some of the slowdown that we've seen vis-a-vis China and some of the impacts of inflation.
Christian, when we spoke with you last time, we spoke about your report talking about the inability for a lot of oil producers to actually produce enough oil, and that people really had not counted in that potential shortfall. We're just getting some headlines from OPEC with Saudi Arabia telling the nations that produce oil that they increased production by more than 11 million barrels per day, basically showing their ability, their capacity to increase output. Does that give you any confidence? Have you seen anything to change your view on that front?
Absolutely not. In fact, it's probably consolidated our view, because what you have is effectively Saudi and some other members of the GCC essentially subsidizing through adding barrels into the market, the oil price, but ultimately that is a limited amount of reserve, right? So we're literally keeping their powder dry through the spare capacity. We do believe Saudi can go north of 12.2 million barrels, but the reality is that we can't just rely on OPEC and Saudi to provide the marginal barrel, because what you then have is US shales slowing down, rig counts are falling because of logistics, supply chain issues. It's amazing, pre and post-COVID, it's like you've dismantled it, a few things have gone rusty, you put it back together again, and it's just not as effective in terms of supply growth from shale. And then you're left with everybody else, so non-GCC, non-US, which is the majors, the IOCs, and they're doing everything but investing in oil. And that's particularly because of all the uncertainty, not just about the front-end volatility of the price, but social tax, windfall tax, giving cash back. So oil capex has never been as far back in the queue. So that leaves more reliance on Saudi to ultimately fill the gap. But the message, I think, around the future is that it can't be just OPEC that underwrite or fill in the deficits when needed. And this is part of our super cycle thesis that in the end, we're going to see a structural deficit that can't be managed or met quickly enough through short cycle barrels.
So does anything make you question your super cycle thesis at a time when you've got Morgan Stanley and you have UBS moving away from some of their previous forecasts and actually cutting their near-term outlook for crude prices? Are you doing the same, or are you doubling down and saying they're missing the boat?
Yeah, I think we're probably in the latter camp of doubling, tripling, quadrupling. I mean, we've been bullish for 2 years now, and all we've seen is this sort of gyration, particularly led by uncertainties around demand. I think there is a degree of sort of confusion as to where demand will ultimately emerge or trend to over the medium term. We still believe that demand will ultimately continue to grow to 107, 108 million barrels by 2030. And the issue is this: if that's right, and we have a shortage of all fuels, and we're back to the same issue, which is how do we meet this energy deficit in the future? It can't be coal, it can't be gas. We're maxed out LNG. It's got to be through solar and wind. And then when you've gone through that, we still have a major deficit in oil, which basically means that we're going to see repricing of oil significantly higher. And so we still stand by our upside case, 150.
Christian, a question that speaks of the moment. I've got like 8 ways to go here, but I think we have to speak of the continent of Europe and the hope or prayer of finding energy in the next 12 months, the next 6 months, maybe even the next 6 years. Maybe it's away from your remit, but do you have an optimism Europe can succeed in staying warm this winter?
I think ultimately we're okay for this winter, and that's because we've had Nord Stream on. We have gas storage up at 90%. Regas capacity is roughly 85%. So we've got the flex, Tom. The issue is not this winter; it's into next winter. And then we start to debate, well, how do we actually structurally fix this long-term supply issue of energy? We can't just provide quick fixes and kick the can down the road. So if anything, I'm more concerned about, as we go into the second half of 2023, how we manage, particularly as China comes back. I think in some ways, China has appeased this deficit, this crisis in Europe by virtue of having lockdowns. If you have lockdowns ease, China reemerges as a marginal buyer of LNG, then we will have deficits in Europe in energy that can't wholly be met through gas, unless we have gas to oil switching, which is clearly bullish demand for oil, particularly through next year, which is why we struggle to take numbers down on demand when all we can see is more demand for oil, particularly as it's still the cheapest fuel relative to all other.
Christian, that was just brilliant, just to hear you break that down. The bullish thesis there with Christian Malik there of JP Morgan Securities. Are we going to have to face another winter of this? That's basically the argument he's laying out for all of us. And Tom, you've raised this a million times, and credit to you. Can you imagine the energy crunch in the world if we didn't have COVID-0 in China?
Absolutely.
Can you imagine how much worse this might be?
I rarely sell a sell-side report, but I've read every word. It literally sits on my coffee table at home in the walk-up. And the basic idea is it's a 100-page JP Morgan essay. Whether you agree or disagree with it, it's a global essay. And it's global dynamics away from the soap opera of America, the soap opera of Europe.
Well, we get to the reality of CPI in just a moment. 5 minutes away, the CPI report just around the corner.
Oh, we have CPI today.
I thought you were counting us down.
Okay.
This is a legit 4.5 minutes away now, Tom.
4.5, 4:30.
Sure, thanks for that.
4:29.
Futures positive, 0.7% on the S&P. Yield's down 6 basis points, 329.47 on a 10-year. An EFX market, a weaker dollar, stronger euro, euro dollar 101, 69.
It's a casual countdown.
This is Bloomberg.
Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The CPI report in America just seconds away. Going into it, equity futures positive 0.75% on the S&P 500. Yields are lower by 6 or 7 basis points on a 10-year. The dollar is weaker, the euro stronger. Euro dollar 101.68. Waiting for that CPI report to come out. Standing by. Here's Mike McKee. Morning, Mike.
It is coming out. It's a little bit higher than anticipated. 0.1% rise for the month of August in the headline number, which is more than the flat reading that we had last month and less than the 0.1 negative reading that was expected. Pushes the year-over-year rate to 8.3%. The forecast had been for 8.1%, so we're a little bit higher. We'll check into the details and see why that is. The core, which matters more to a lot of people, rises 0.6%. That is double last month and double what's expected. Pushes the year-over-year rate to 6.3% from 5.9% last month. The expectation was for a 6.1% move. So some bad news on inflation here, but does it really matter? Because everybody was kind of expecting the Fed to go 75 anyway. Quick look at what some of the increases come from. Food is up 0.8%. Food at home, your grocery store, up 0.7, and energy, this is the one that was supposed to be the big wild card. Gasoline down 10.6%. It was up 44% on the year last month. Now it's only up 25.6% on the year. New cars are up by 0.8%. That is probably one of the disappointments in this number. Used cars fall 0.1%. There was a forecast that they would be down as much as 1% in this index, and so that is another disappointment. While prices fall, they do not fall as much as the wholesale price index had suggested. And then shelter, the rent component that everybody's been concerned about, that keeps rising even faster, up 0.7% after a 0.5% move last month, and on a year-over-year basis, shelter costs up 6.2%. So we are a long way from saying that inflation is conquered and has peaked, and so the Fed has still more work to do. Obviously cements a 75 basis point move.
Mike McKee, doubling down on that going into next week. Mike McKee, thank you. 75, and some might argue it changes the tone of that news conference with the Fed chair as well. Lisa, we're looking at equity markets lower by more than 1 full percentage point. We were firm, and now we're negative by 1.35% on the S&P 500. Yields are higher on a 10-year back through 340. Yeah. That's going to bring back the conversation about whether we have actually seen the high for the year on the 10-year. But the work we're doing at the front end of the yield curve right now, bang, slicing through 360, yields much, much higher at the front end of the curve.
This raises a question, not for this meeting coming up next week, but the meeting after and the meeting after. So to your point from earlier, do we go down to 50? Do we go back down to 25? Or do they stay at 75 basis points? I mean, this really changes the discussion at a time when a lot of Fed officials are saying they want to keep rates probably close to 4% for a while. We haven't really factored that in yet.
If you wanted to see a persistent and convincing string of economic data, Tom, inflation prints, to back off rate hikes, then we just got disruption. That's a disrupting data point for this Federal Reserve to see month-over-month core pick up in the way it did again, Tom. That's going to change the conversation next week.
To scope and scale here, the real yield came just within 4 decimal points of 1% on the real yield here, which is, to me, a sea change. To see a full percentage point of 10-year real yield, we had a 600-point Dow swing from basically plus 200 to minus 400. It's a huge shift, a huge disappointment. What was the landing that we had earlier this morning?
Soft.
Soft. That's it. We were very soft.
I don't think anyone's talking about that right now. What you've heard from Fed Chair Jay Powell, from Vice Chair Lael Brainerd, from Mr. Wallace, the governor over at the Federal Reserve, what you've also heard from Jim Bullard repeatedly, what are they going to say? This is exactly what we're talking about.
This is not about Fed officials. This is about a narrative shift in markets. Markets catching up to what the Fed is looking at, and that will be the discussion through the remainder of the day as they parse through this data and say, what were we getting wrong when we assumed we would see disinflation, and we are not? And I think that is what's going to drive the trading action.
So equities down, going into the opening bell about an hour away. We're down by 1.3% on the S&P 500. We talked about that move through the front end of the yield curve, through 360 on a 2-year. That's a fresh high, fresh multi-year high at that as well for a 2-year yield in America in the Treasury market. And on 10s up by 6 basis points through 340. Jay Bryson standing by, the chief economist over at Wells Fargo. Jay, just initially your reaction to a much, much hotter CPI print.
Well, I think, Mike nailed it earlier. I mean, if there's any doubt at all about 75, they're definitely going 75. And then, Lisa, I think you had a very good comment there as well. What does this mean about November? I mean, we thought they would be stepping it back to November, to 50 in November. And at this point, you would say 75 is certainly going to be on the table there in November.
Jay, how do you take this data, this financialization shock over to the real economy? What does this 830 number signal about potential slowdown in economic growth?
Well, Tom, I think what you're looking at here is there's 2 things that's going on with the inflation, right? One is that inflation is going to continue to eat into nominal income. And so what we've seen, if you're looking at real disposable income, year over year, at least in July, it was down 3.7%. And so you can't continue to have consumer spending grow if real income is contracting like that. So that's the first problem with inflation. The second problem is it puts the Fed into overdrive. And if they're in overdrive, sooner or later they're going to make a policy mistake. And if we're talking 75, 75, 75, so far as the eye can see, they're going to make that policy mistake and it potentially could put the economy into recession, which is what we think is going to happen early next year.
Jay, why did almost all forecasters get this wrong?
Well, there's a bunch of volatility on a month-by-month sort of basis here. We were above consensus, but we weren't at 0.6. I think the big thing here that's really pushing a lot of this, and this is why it's going to be hard to bring inflation down in the near term, is the shelter component. The way they treat shelter, the way they treat housing in here comes in with a long lag. And we all know what's happened over the last year or so. Housing prices have exploded. And it came into the CPI relatively slowly. It's coming in with a vengeance now. The problem is it's going to continue to come in as well. And so that's going to keep the CPI inflation rate elevated for the foreseeable future.
Jay, many Fed officials have given us the impression that what they wanted was 2 or 3 softer inflation reports to rethink the trajectory of rate hikes. As Lisa mentioned, and you alluded to it, do you think this really disrupts their ability to say in November that we need to go a different direction?
Well, yeah, I think, well, obviously we've got a lot of data coming out between here in November. So, we'll see, right? But, if they want to see 2 or 3 soft prints in a row, we've just reset the clock back to 0 right now. And so, 75 obviously is on the table, I think, in November. We'll see what happens to the real economy. We'll have, 2 more employment reports between now and then. That'll be key. So if you do see slowing in the real economy, maybe it backs off. But right now, we haven't seen tremendous amount of slowing in the real economy, and that keeps these supersized rate hikes in play.
Jay, can you tell me where you expect to see unemployment by year end? And at the moment, this Fed, as you know, is very, very focused on the one side of the mandate, bringing inflation lower. We're all trying to work out whether the 2 sides of the mandate come into more conflict as we get closer to year end.
So our view, John, is at the end of the year, you're looking at an unemployment rate somewhere around 3.7 or so. So I think that's still a very, very tight labor market. Now, as we go into early next year, and as we see, deceleration and then contraction in economic activity, I think that's when you see the unemployment rate start to move. But if we're still at 3.7, or let's say we're still below 4%, we still have a 3 handle at the end of this year, I don't think the Fed is slowing down at that point.
What does this say, Jay, about the inertial force of supposed disinflation? I think we're talking about getting to 5 or 4% inflation out there, but do we blow that up today and say simply our path is to get to 7 or 6.9% inflation?
Well, Tom, I do believe that you are going to continue to see. So our view that inflation starts to recede next year is predicated on our view that you do have a recession. And if you do have a recession, then what you do see is goods prices will definitely start to decelerate, as will service prices as well. The good thing, if there's anything that's good here, is that we have not seen inflation expectations become, quote, unmoored. That's a word that the Fed will uses all the time, and so that's a good thing, because if that does become unmoored, then that creates its own dynamic as well. People start to pull forward their expenditures, which pushes up inflation. They ask for higher and higher wage increases as well. Fortunately, we haven't seen it become unmoored, but if you continue to see prints like this, then you do start to worry about that happening.
Right. For all of you on Bloomberg Radio, Bloomberg Television, Dr. Jay Bryson with us with Wells Fargo here. A stunning inflation report. John, is that the right word?
I think you can call it that.
Stunning,
certainly an upside surprise, Tom.
Stunning inflation report. Futures turn around. I'm doing the math in my head, John. Help me out here. 2.5% flip-flop in what we see on S&P
on the
futures.
Nasdaq 100 and some. We're down 2.4%.
Yeah.
This disrupts the idea that this Fed can back away anytime soon, Tom. It's a bit of a reality
Well, I'll go with the disruption, or just to say that we got to rip up the script and come up with a whole new dialogue. We do that with Michael McKee, who's dived into the inflation report a little more. Michael, what is the distinction between service dynamic and goods dynamic?
Well, right now it looks like services are starting to pick up some speed here. Services less energy rise by 0.6%. That's after 0.4 last month, and now services are up 6.1% over the year. So we are seeing service prices start to rise, and you can see it in a number of areas. Interestingly, education, tuition, college tuition. It's time for kids to go back to school, and that was up 0.5%, a fairly strong increase for that category.
I'm shocked.
So yeah. You would know something about that, Tom. We're also seeing motor vehicle insurance up 1.3%. That's been an ongoing issue. And airline fares fell 4.6%, but they had fallen 7.8% the month before. So we're losing a little of the benefit from that. So you are seeing services rise. There was one thing I did want to mention. Somebody asked me this morning if we could mention this because it matters to senior citizens. The Consumer Price Index for urban wage earners was up 8.7%. We'll have to see what the average numbers come out to be once September's numbers come in, but that will lead into the Social Security COLA. And if you're looking at an 8.7% increase, that's going to be pretty big.
See that? From London.
Was it
He's
you that
looking at me.
asked?
I'm in London and McKee's looking at me.
Mike McKee, it's good to hear from you, sir. It's great to have you break that down for us alongside Jay Bryson of Wells Fargo. I'm going to totally avoid that and focus on this market. That month-over-month core print at 0.6%, when we were looking for 0.3%, it's much hotter than anticipated.
Yes.
And you can see how the market's reacting to all of this. Equities negative, really rolling over, and yields really punching higher at the front end. The 2-year, Lisa, back through 360. When was the last time we could say that?
It's been a while. It's been close to the highs that we've seen this year, and those would be the highest levels going back.
2007?
Yeah, 2007. More than a decade. More than more than
Is
15
this
years.
data dependent?
I know exactly.
Are we living data dependency?
Can I just say yes, but just one more thing. I was doing some reading and of the reaction that people were saying, and the number of people saying the likelihood of a 75 basis point rate hike, just like we were hearing from Jay Bryson, is growing in November. Not just September, in November. So all of a sudden you start seeing that get priced into the Fed funds futures. That's a new level of tightening.
You're asking the right question. It's not about next week. It's about what happens after that, Tom.
Yeah, it does. And of course, some of that comes back to economic growth, and it comes back to the tea leaves all of us in economics, finance, and investment glean from the short-term bond market. We're going to do that right now. Ira Jersey joins us, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, what should we watch in your space, your world? What will give us the signals off this shock report?
Yeah, I think it's that 2-year yield that you guys were just highlighting, and the fact that we're at levels where we haven't been since before the global financial crisis back in 2007. You know, the fact is that we had continued to price for the Federal Reserve to continue to hike interest rates. The question still is, how high do they go, and then how long do they hold them there? And I think, you know, a lot of the data from this report, and, you know, it's always just one report, but when you get one report again and again and again, that tends to look at things like core service prices continuing to grow as quickly as they are, then, you know, the Federal Reserve has to worry that that inflation is going to stay well above their 2% target for a long time. In fact, you know, I think, you know, some investors that I've been talking to are questioning whether or not they can actually keep that 2% target as their guidepost, that maybe they need to be at 2.5% or 3% or have some range between, you know, 2 and 4 or something like that, because we're in an environment where it's very likely that inflation is going to stay this high, or, well, not this high, but above 2% for several years, and that means that they're not going to ever hit their target unless they hike interest rates more than the market's pricing.
And that's the Adam Posen view of perhaps targeting 3% rather than 2%. But they are not doing that right now, Ira, and we are hearing from Fed officials talking up a 4% Fed funds rate as a likelihood early next year or middle next year. How mispriced is that in markets right now, and do you think that that's realistic?
Well, the market's getting there. So the market's priced for around the upper band to be about 4%, and I think, and my view is that the upper band eventually will be at around 4.5. So, and Bloomberg Economics, of course, is even a little bit higher than that. And certainly, you know, directionally, I think that the market needs to start pricing for somewhere above 4% in terms of the Fed funds rate. We're not quite there yet. When you see 2-year yields upwards of around 375, 390, that'll be a signal that we're finally there, and we're getting there, and we're getting there quickly.
John Farrow, CIBC World Markets in Toronto, they focus on shelters, we've talked, but they also add medical care as part of this core surge that we've seen.
It goes back to this persistent thing.
Yeah.
How much longer is inflation going to remain at these kind of levels? Ira, can you talk to me about this move we're seeing in the 2-year? You picked up on it, let's discuss it. We're basically at 370 now on a 2-year yield. We're not far away from it. Ira, how much upside do you think there actually might be on a 2-year based on where it is now?
Yeah, so our year-end target is 390, and that's predicated on the idea that the Fed's going to hike to around 4.5%, and then in 2024 start to cut. But you know, you get another CPI print or two similar to this, and we'll have to rethink that view in a pretty big way. I think, you know, 2-year yields are going to certainly be much more sensitive to what the Federal Reserve is doing than say the 10-year yield. And I think the important bit is that eventually the 10-year yield is going to really lag behind. I mean, it already has for about almost 2% over the last year. But I do think that the 10-year yield eventually will start to rally a little bit on the idea that, look, the Fed has to hike a lot more than they want to, and we're going to have a hard landing. So the yield curve will just invert more and more.
What will you listen for from the Fed? How do they change their dialogue off this report? To me, it completely, it vindicates what Powell was talking about at Jackson Hole. How do they move forward?
Yeah, I think that's right. You know, I don't think that they really have to change the narrative very much at all. The Fed's been pretty consistent. The market just hasn't believed them, or large parts of the market haven't believed them. Look, all the investors that we've talked to, that I talked to, are in two camps. One is the Fed's way behind the curve. They have to hike a lot more. They need to go 100 basis points at the September meeting, and then and keep going to 5, 6, 7%. And then you have another group of investors that's saying the Fed can't go much beyond 4% because they're already going to be pricing in for a recession and a hard landing and all these other things. So you have this very bifurcated view where everything centers around maybe what we're pricing right now, but you have these two very disparate views, and as people shift from one of those views to the other, you're seeing these very big moves in markets, and liquidity has been pretty poor as well because of structural issues going on in the Treasury market. So you're going to continue to see these 10, 15, 20 basis point moves on a pretty regular basis as the sentiment shifts so significantly.
Ira Jersey of Bloomberg Intelligence. Ira, thank you. I think some people might argue going into that Fed meeting next week that the chairman should just take the speech from Jackson Hole, Wyoming, bring it out and just read it again. I mean, this is it, isn't it?
We're living this, and I think we're hugely biased in New York, John, and maybe biased in London as well. No, but I mean, in New York, we're living this rental buying, selling reality.
A lot of the country.
How do you substitute that? If I like Budweiser and it goes up, I can substitute to Miller champagne of bottled beers. How do you substitute your rent?
I'd take it a step further. Lisa brought this up. I remember, was it a month, 2 months ago? You brought up the mortgage costs.
Yeah.
It's really
What
expensive
do they
to buy,
do?
right?
Exactly.
So a lot of people are left with no option other to rent.
Right. This is sort of counterintuitive, because if you get higher costs to buy, you would think that would tighten the labor market or tighten the housing market, and then that would reduce housing costs, right? But in fact, it increases the cost of renting, and you're seeing that across the board.
It is a different week here in London. We've had a pause today in the services for Queen Elizabeth, and it's allowed us to actually catch up with members of our wonderful London team. One of them, who you've heard often in America on Bloomberg Radio, Bloomberg Television, is Marcus Ashworth. To say he writes for Bloomberg Opinion barely describes his market excellence with service at Barclays over the years, and 14 other institutions that you and I have forgotten about have been merged into oblivion. Marcus, wonderful to catch up with you today. What does this stunning report mean for Governor Bailey, who the day after the Fed meeting has to adapt and adjust to the central banker in the inflation of the world?
When I saw this report, the first thing I thought was ouch for America, but double ouch the rest of the world. But, the dollar is just is killing everything, and it's now killing it even more. And 2-year yields up where they are, which to my mind, it's one number. We've got to look at these data and think that no one can measure inflation properly. Some central banks have opened up to that fact. So let's not get too focused on one report. Nonetheless, it does look pretty unfortunate. Everyone had gone one way and expecting not a Fed pivot, but that there was enough ammunition at some point there would be a reason to have a Fed pivot. That's just been swept away.
It's a reality check.
Yeah, it's a reality check when, Powell had given that to us at Jackson Hole, but now's the data proving it. And that's awful for the UK. It's even more awful for Europe, and let alone emerging markets. It's a disaster. It's a very bad print. Because the US are going to overdo it, and they're going to break something. And what they're going to break is the rest of the world.
Well, let's talk about it. Let's talk about the bank around the corner on Threadneedle Street, the Bank of England. Tom raised the question. Are we at that point now when we can just call it what it looks like it is, which is a little bit of a war? It's like the reverse of the FX war we had maybe 10 years ago. Is that what we have?
Well, the only good thing about the UK is that they're making the most stupid mistake ever trying to fiscally tighten under Rishi Sunak. That's gone away. This new government is going to unwind everything he did in the last sort of year or so. Post-furlough, we're going to get a very big fiscal stimulus, which is what's needed. And we should have never had the tightening to start off with. So that's the only good thing going, I think, for the UK in that sense. Sterling's already really cheap. In that sense, yes, they can hike. I don't think they need to hike quite so much than perhaps other central banks do. because the consumer hit a brick wall in February in this country. And I think, therefore, we've got quantitative tightening, which is the first one to be active. That probably comes this month or next month. That's going to be quite a big impact.
John, I know the lease about 115.83 on sterling is a wow shift.
It's not 114, and that's the good news, because it was threatening to break through 114.
Yeah, we're two-thirds of the way there.
Where we are right now in this bond market, Bramo, is where I think we both want to go.
Right.
We're up 5 basis points on a 10-year at 340. We've all got that long list of people who said we've seen the highs of the year. I wonder if they have to rethink that, because the highs of the year on a 10-year are about 10 basis points now. On a 2-year, already through them.
As you were saying before, we are through those highs, and we are now at the highest level going back to November 2007, even on an intraday level. And this really raises question from the international perspective about whether some of the other central banks are only hiking to keep pace with the United States and not because their economies necessarily need this. And Marcus, I do wonder from your perspective, more pronounced more quickly.
Well, I mean, the pain in the UK is, I said, somewhat softened by this big fiscal package which is coming. In Europe, I really worry because, you know, we've got so much problems coming through on the German economy in particular, and you know, the European Central Bank seems to have got the zeal that it needs to hike 75 basis points to keep up with the Fed. And that's the problem. I think the rest of the world is going to be broken. At some point, that will feed through to the US economy, and they might stop hiking.
We're out of time, 30 seconds. Credit Suisse, you're expert. What if they breach €5, 5 whatever per share? What are the ramifications?
Well, I think Credit Suisse is just what it's good at. It's private wealth management and one or two other things. I think they have to go back to core, get rid of the risk culture. But, you know, intrinsically, it's a decent bank, and I don't think it'll be bought out, so there's no M&A premium, unfortunately.
Swiss francs, TK.
I can't keep track.
Oh, you can. You love the Swissy and the SMB.
I don't like it because you go to the McDonald's and Bond
Think about what they've got to do. Yeah. The SMB, the Bank of England. We've all discussed it, haven't we? ECB's gone 75. Fed's about to go 75. Looks nailed on now into next week. Day after, Bank of England. They've got to do the same thing.
It's the summer of 75. Isn't that what Citigroup said?
I think, the summer of 75. I missed that.
Yeah.
I didn't see that.
Yeah.
Is that Hollenhorst?
Yeah, I think so.
I wasn't listening to it. Was that this morning?
No, it wasn't this morning. It was in a note. No, it was not
Okay.
this morning. It was a couple of weeks ago in a note. And he said, this is summer of 75. And I think that's about right.
Jennifer O'Neill was in that movie.
Oh, really?
She was.
Okay.
Summer of 75.
I'm going to wait for the price action.
Just to the market.
Yeah, let's get
exactly.
there. Inflation came in 25 minutes ago, hotter than anticipated. Month-over-month core is where this market was focused. Month-over-month core came in with a big upside surprise. That means equities lower. We're down 2% on the S&P 500
We continue to deteriorate.
Euro-dollar, big turnaround, negative 0.75%. That's a weaker euro, much stronger dollar. Talked a lot about the moves across the bond curve. 2s out to 10s, 10s up by 6 or 7 basis points, 342. Where's your 2-year now?
It's 170. I mean,
370.
370.
Well, exactly.
Like 170 because you got.
Well, I mean, I got very comfortable with the one handle for a long time.
Right.
Then 2, and now it seems 3 is the place to be. 370. And Ira Jersey of Bloomberg was talking up 390.
Yeah, it's beyond 370. Well, if you think about a base case that markets are pricing in, that you're going to see a 4% Fed funds rate, and they're going to hold it there for a longer period of time, well, it makes a lot of sense.
John, 700 Dow points, most of that in the last 20 minutes. Where are we at 3 p.m., 4 p.m. today?
Seriously.
1,000 points?
We're going to ask Krishna Mamani of Lafayette College. He's going to join us alongside Esty Dweck of Floyd Bank, David Kelly of JP Morgan Asset Management. TK and I have worked together for so long. I've learned to ignore him at specific times, particularly around the time he mentions down points. And how many points?
700
Thank you.
points.
Thank
These are
you.
huge moves. Look at the NASDAQ you mentioned earlier.
Yeah.
NASDAQ is huge.
Big move lower in this equity market. We'll break it all down for you in just a moment. Upside surprise on CPI in America. That means a big downward move on this equity market. The countdown to the open just around the corner. With 35 minutes away, this is Bloomberg.
traders, good afternoon. We did it. As you can see, we sold Bitcoin just right here, and as soon as we sold, it moved up. We made 7%, because we trade on margin. We made £7,000. Well done, guys. All of you guys who copied my trade and follow me.
Leaders in legislation.
You made quite a good, decent profit.
The theory of this business, I understand it.
It's all, of course, it depends on how much you decided to invest, when you entered position. But at the end of the day, we end up in the profit. For somebody, it might be £700, £2,000, or £500. It's at the end of the day, it's all profit.
When you think space,
okay, guys?
you probably think...
Great. Let's see what's going to happen with Forex today, because quite a few movements happened after the news appeared just half an hour ago. So stay with me and keep an eye on Euro, British Pound, Japanese Yen.
We've collaborated with pretty much everybody.
I'll speak to you later. Stay safe, guys.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon. Can ESA help humanity take its next giant leap?
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. Katie Fogarty crossed over from a Wall Street analyst role to steer Shake Shack through a critical transformation.
Before, it was a lot of kind of sitting in an armchair type basis. Here, it is driving a plan of how we can best maximize shareholder returns.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday. The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. This is an extended edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from London for our audience worldwide, counting you down to the opening bell. Good afternoon from London. Good morning to your stateside, waiting for that cash open with equity futures dramatically lower, down by 2% on the S&P 500, negative by 2.9 on the Nasdaq. TK off the back of a much, much hotter than expected CPI report in America.
With global ramifications, there's no question about it. Let's go to the States. We're going to go to Anne-Marie Horton and what the White House response to this will be here in the half hour. But John, I really want to emphasize how many people got this wrong, and one lone voice at Jackson Hole nailed it.
Chairman Powell himself, we've got work to do, and everybody else has followed him on that Federal Reserve. This market, though, some participants, Lisa, ignoring that Fed communication, waiting for that soft landing. Some of the data recently spoke to that. This data point did not.
No, and that's the reason why I find it fascinating. The knee-jerk reaction in markets is as dramatic as it is. People really have believed that the Fed had it wrong and that they were right, and that there was just disinflationary tilt, and you were going to see inflation slow much more than it actually has. This raises a lot of questions about what's in assumptions and how much further the sell-off has to go.
To Tom's point, it will be very interesting to see how the White House responds to this.
Yes.
Because the month-over-month numbers have come in much hotter than anticipated. We talked about the front page of the newspaper going with the headline numbers. Wall Street was looking at month-over-month core, and you said even within month-over-month core, you need to go deeper. Doesn't speak to a story that's fading anytime soon.
No, it came in double where people had expected it to. If you look at month-to-month core inflation, and when it comes to the White House's response, this comes at a difficult time when President Biden is now about to campaign on the fact that they're getting inflation under control, and people are less worried about inflation. He's pointing to gasoline prices. This flies in the face of that narrative.
I wonder if he's rewriting some of those speeches.
Think it's him?
Well, whoever's writing those speeches.
Exactly.
As is often the case of any administration, it's usually someone else. Equities down, yields up, it's 2s out to 10s, your 10-year yield is much higher, your 2-year. Well, we're now got to get used to 370 on a 2-year, Tom. Can you get used to 370 on a 2-year?
No, I cannot. And moments ago, a massive moment for these markets in the years that we've been doing this, the 10-year real yield at 1.00%. It is, John, the signal of that. For those of you that aren't on Global Wall Street, John, explain why 1.00, 10-year, the real yield, why that's important.
Toxic for risk assets. And those kind of levels remind me of where we were in late 2018, where the equity market, let's face it, collapsed. Some people might not like that word. And yields, spreads on credit, Lisa, they were much, much wider than where they are now.
For years, there was no alternative. Now there is an alternative because you're actually getting yields and income from some of these instruments, and that, I think, is the big takeaway from real yields climbing.
Mike McKee is going to join us now to break down some of this economic data. Mike, this wasn't the number many people were looking for.
No, some people were thinking that way on Wall Street, but let's go through some of the numbers that are making you three so gloomy this morning. The month-over-month CPI comes in at 0.1%, which is higher than the negative 0.1% that had been expected. So we see the headline fall to 8.3% from 8.5%. But the core is the one you're talking about, was up 0.6%. Last month was 0.3. The forecast was 0.3. So we see the core rate rise to 6.3% from 5.9%. I'm guessing Joe Biden will not be talking about the core rate this afternoon. What moved in the indexes? Well, you can see there, gasoline kept its part of the bargain. It fell 10.6%. We knew that that had gone down quite a bit. Yeah. But food has not reversed. People were thinking when the commodities started to fall in July that we would see a drop in food prices. We don't. We certainly don't see a drop in shelter prices. Owner's equivalent rent is up. Used cars were down 0.1%, but on a wholesale basis, the expectation was they might be down as much as 1 to 1.5%. So that's a disappointment. And apparel prices, no sell-off of inventory there. They're still rising 0.2% on the month. Now, just a few moments ago, you had Ira Jersey on, who said that the Fed is going to be determined to get up to restrictive territory. And as we watch what's happening in the futures markets, and people are pricing in 75 now for the September meeting and a possibility of 75 for the November meeting, you can see here that the Fed in the past has always raised interest rates above the level of CPI, both CPI and core. And you can see all the way over on the left, on the right there, they're a long way from that. So we need inflation to come down, or we need the Fed rate to go up before you're probably going to see much success at bringing overall inflation lower.
Mike, very quickly here, if I was having a beverage of my choice at Jackson Hole with any selected Fed presidents, what would they say is the distance to neutrality? Is it November? Is it into next year? When is the when of getting to neutral?
Generally, the feeling has been they want to be there by the end of the year, and that gives them 2 more meetings to do it. So then you have to define what neutral is. Some of them think 3.5, some of them think 4 or a little above. So that gives you a wide parameter of possibilities for raising rates over the next couple of meetings. Tom, I can also point out that you probably helped because obviously supply not keeping up with demand with those beverages of your choice. Alcoholic beverages up 9/10 during the month of August.
I can tell you that's a true story. Mike McKee, thank you. As I sit there with a pot of tea and Tom's on martini number 4, as is often the case around dinner, not breakfast. That's impressive.
Thank you.
It's around dinner and not breakfast. Krishna Mamani's with us of Lafayette College, the CIO. Krishna, you've got to respond to this one for us. Equities down and down hard. I think I've got the S&P off 2%. Granted, over the last 4 days, we were up about 5%. But your thoughts on what we got 35 minutes ago?
Well, so I think Jay Powell basically laid it out from a policy standpoint. And if you focus on that, nothing has really changed that much in that, inflation is high and they will continue to tighten. And if you are looking for a pivot, last few days and probably last few weeks, you turbocharge your expectations and you'll probably be giving all of that back. The bottom line is the Fed is looking to get it to 4% or higher. And they will get there either this year or early next year. The real question for the market is, one, how long do they stay at that terminal rate north of 4%? And will they pivot because of something breaking? I think that's what we are dealing with. Kind of looking at this month's number, contrasted with the last month's number. We didn't have as much of a reason to be as optimistic last month. And this month, probably if we projected too much, there's probably not too much of a reason for us to be that pessimistic. Inflation is slowing down, but not at the pace that the Fed is comfortable with. And that's what the markets have to deal with.
So what's your sense of when it is a good time to go into debt, to go into duration, to start saying we have seen the highs in the 10-year because we are going to get up to 4% or beyond, and that's going to lead inflation to get under control? Do you get more of a sense of that now with the CPI print?
Well, no, so I would say that both the treasury markets and the credit markets are probably a lot more vulnerable than the equity markets, for the very simple reason that we really don't know at what level the Fed is going to stop and at how long they would stay at that level. That's really not a very conducive environment for owning credit assets, or for that matter, owning safe assets. I think there will be a time, but it certainly is not today. Equity markets, at least you can make a case that the valuations have come down, and if we are not in a recession and probably don't get into a recession, it probably may not be such a bad bet given the upside. In the bond markets, you don't have that at the moment.
Well, but Krishna, a lot of people would say that stock and bond markets have been moving in lockstep, and that when bonds sell off, so do stocks, particularly big tech, which has driven a lot of the activity. So what's your pushback to that, to say, no, equity still can be a haven at a time when debt instruments are at the precipice of the volatility?
Well, so if you look at the last few weeks, equity markets did reasonably well despite bond markets selling off. So almost 30-odd basis point rise in rates, and probably higher than that by now. And equities held up reasonably well. So I'm not saying equities are not vulnerable. What I am saying, however, given the potential upside from any change that may come in the environment, equities, you can capture that upside. In bonds, it's far riskier.
Krishna, very importantly, and this is to institutional Wall Street, we are going to see new lows in price for the various Bloomberg aggregate indexes. What's going to be the blood on the streets institutionally of new lower bond prices with higher yields?
Well, so, I think from a longer term perspective, as Lisa had indicated before, we really did not have much of a choice other than owning equities. And that option is being created. At some point, we will get to terminal rate. At some point, the Fed will pivot. And therefore, I think bond assets, they may not be at their lows just yet, but from a longer term perspective, bonds are becoming a much more viable asset class than they have been over the last 5-10 years. And that is that is really good for the institutional world. If you kind of go back, what the world wants is a good bond with the high enough yield. If they can get that, they don't care about equities. And
Krishna, that's what we all want.
We are getting closer to that.
We're getting closer, Krishna. I've got to ask you this. We're getting closer to the Fed next week. Everyone's going to say 75. I get that. Can you tell me what you think the forecasts are going to look like next week? Because we do get the new refreshed summary of economic projections. What kind of shape do you think that's going to take?
Well, so, they perhaps have been a bit more optimistic than they should have been. And, a lot of commentators have kind of chided them for that. And I think that would probably still be true. The real question is, what do they do over the next few meetings, and how quickly do they get to the terminal rate that they are striving for? And I think if today's data is any indication, they would probably hurry it up, because right now the economy is in a good enough shape where they can take that risk, and the economy can take that punishment. So my expectation would be that rate increase expectations have to be brought forward. That's what the Fed wants to do. They want to get to the terminal rate as fast as they possibly can, and then hopefully hold there. Whether they will be able to hold there is a separate question altogether.
Hey, Krishna, thank you. Krishna Mamani there of Lafayette College. Off the back of this hotter than expected CPI report and going into the Federal Reserve next week, I've got to squeeze this in because you know someone's asking me.
I know.
Quiet period. No Fed speak.
No Fed speak. That's the reason why.
Do you think they might?
We might get something from one particular reporter at the Wall Street Journal to basically say.
Not saying,
but honestly, what are they going to say that they haven't already said?
I hear you.
I mean, they have been very deliberate and they have been very vocal and united in saying, we're going to hike rates.
And people have chosen to ignore them.
Right.
Now, Tom, in the summary of economic projections that we get next week, are you expecting to see inflation adjusted higher, growth lower, dots out there up by 4 and for a whole lot longer?
They will manage the message and it'll all be vector-based and they'll do it with gradual approach, which they do. I want to look at the right now, which is under no circumstances, John, here now, 1 hour after this folly, 45 minutes after this folly, have we seen a bid? We've got Dow 800 points. We're going to get a down negative 1,000. Here we're going to get a VIX out 2 big figures. The SPX, of course, is what institutional Wall Street's looking at. These are markets on the move this afternoon.
The S&P 500 down by more than 2%. The Nasdaq 100 down by 2.9%. Going into the opening bell, 17 minutes away. Wow. In just a moment, we'll catch up with Flowbank's CIO, Esti Dweck, on some of the price action, and we'll speak to AMH down in D.C. on what the White House might have to say about this. This is Bloomberg.
went back and looked, and very few secretaries of state in the last 100 years, or maybe ever, have really gone back into government. So why did you want to come back into government for any issue when you've got 8 grandchildren, you've got 2 daughters, you've got wonderful family? Why did you want to come back and go through this terrible process we have in Washington of getting things through consensus and getting people to agree to what you want to do?
Because I want those grandchildren to have a future. It's very simple. We're not in a good track right now. The world is not serious enough about reducing our emissions fast enough, David. And the result is that the planet is going to continue to evolve in reaction to what we human beings are doing to it, mostly through fossil fuels. Most of the emissions that are going up nowadays into the atmosphere and are creating this increased level of energy that comes from the ocean, goes into the storms, the floods, the rain. All of it is explainable, and it's all linked to the changes we are creating on the planet. So it's very simple. I wanted to come in because I think we have a real chance now to make something happen, and I think Glasgow was a major step forward in the effort to do that.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We are 13 minutes away from the opening bell in New York City, and equities are down and down hard. Negative 2.35% on the S&P 500, on the Nasdaq 100, down by 3 full percentage points after a hotter than expected inflation report in America. Joining us from Washington now, Bloomberg's Anne-Marie. AMH, let's talk about it. How is the president going to respond to this one?
Well, it's kind of an awkward moment because at 3 p.m. later today, he's going to be gathered with members of Congress, his cabinet, environmentalists, mayors to talk about this historic legislation, the Inflation Reduction Act, which is massive legislation. They decided to call it Inflation Reduction Act for a reason. They knew this was going into the midterm elections, going to be one of the biggest issues. This, of course, has money going towards climate change, a 15% corporate minimum tax. We make over $1 billion as a corporation, and lowering the cost of Medicare. But how much is the president going to be able to stick that message with the fact that inflation today is higher? I imagine the one piece of spin that they're going to want to really grapple with is that they worked all summer to try to bring gasoline prices down from where it was at the June peak of over $5 a gallon to now just under $4 a gallon with $3.70. That was the one bright spot of this inflation report. But obviously, just less than 2 months away from the midterm elections, Republicans are really going to harp on this.
Anne-Marie, which party is advantaged by sustained inflation?
That would be the Republicans going into the midterm elections, right? Because they're the ones that can say, look, inflation is not coming down. It was not transitory, something that this White House, something that the Treasury down the block from me had told us it would be. So it's the Republicans that want to make sure that this message is top of mind of voters, of consumers, higher food prices, higher electricity bills. If you look at the inflation report, yeah, gasoline is coming down, but natural gas and electricity is higher rents. All of this is being eclipsed if you're not getting the wage gains, and that's their biggest problem. But the one thing the Democrats do have with some wind in their sails following, the strike down of Roe v. Wade is that this is now a live issue. We saw that in that congressional district, that swing district in New York. We saw that in Kansas. And there was a recent Wall Street Journal poll that said, yes, overall economy is #1 for voters to go to the polls. #2 was abortion and women's health care and reproductive rights. And #3 was inflation.
Anne-Marie, thank you so much. I'm sure there'll be a reset down in Washington, D.C. as President Biden tries to double down on a message. It's a little cloudier after this latest data. Of course, the message is a little cloudier in markets. Esty Dweck, CIO of Flowbank, joining us now. We are seeing NASDAQ down 2.9%, a reset of the idea of a disinflationary tilt that we thought would take hold but didn't. Are you rethinking any of your positions today?
Well, it was never going to be a straight line down. We have a number of inflation data points that are still showing that disinflation is happening. Clearly, the core print for today was not fantastic, and we're seeing the disappointment in markets, especially because we had that expectations in the last couple of days that really ramped up and boosted markets. From a positioning perspective, we still have PPI tomorrow. We have the Michigan numbers coming up at the end of the week. we had inflation expectations in the last couple of days showing us that those have come down quite sharply as well. So I think the disinflation trend is going to continue, but for today, it's definitely going to be ugly.
John, we're getting in the numbers right now. Peter Bookfire has one of the isolated incidents, health insurance up 24% year over year.
Services.
Services is the distinction feature.
Without a doubt. Esty, with that in mind, we've got this tug of war between financial conditions and what is happening with the data and how the Fed is responding to it, and investors who are hoping all of this goes away and next year it's smooth sailing. What's your message to people that still doubt the resolve of this Federal Reserve?
Well, there wasn't going to be a pivot, and there clearly isn't going to be a pivot anytime soon. I think Jackson Hole dispelled that idea completely. Anything close to a pivot would just mean we're going to stop hiking, and that happens at some point in 2023. And how many more percentage they get in before that? That number is going up, of course, with the November expectations rising as well. But the Fed isn't going to blink. Inflation is gradually coming down, slower than anyone would like, but their resolve is going to be very firm.
Esty, where do I hide? Just as simple as that. My head is spinning. This report wasn't what I expected. Where do I hide to drag myself into 2023?
So I think it's a bit too early to say that the entire end of the year is going to be bad. I think at some point we are going to have some improvement in markets. For the time being, it feels really like the dollar is a great place to hide. The Swiss franc, you were talking earlier about the Swiss National Bank coming in with those hikes. So Swiss franc probably is another place to hide. But you're making something in cash, and I think a lot of investors are going to be happy to sit in cash and wait for the picture to improve, hopefully over the next couple of weeks.
Esty, thank you. Esty Dweck there at Flowbank. Tom with the money question. Where do you hide when equities are down and yields up and treasuries are getting battered? And that's what we're seeing on 10s, on 2s. I had a message just a moment ago from a Bloomberg Terminal subscriber. There goes Goldilocks. You remember after the payrolls report? I said it, I sat there looking at that one specific data point. It spoke to that theme. The inflation report just wiped the floor with that idea because this Fed has got a whole lot more work to do.
I keep thinking about what Ira Jersey said, particularly with quantitative tightening picking up, and that we weren't going to see the effects of that until early next year when all of a sudden banks are going to have to go out and actually pay people more to put their deposits with them. And at what point do we get more and more people just parking their money then in their checking accounts because you're actually getting something for it suddenly?
Where does QT fit in here?
This is the question because it's accelerating right now. This week, it actually is starting to accelerate. So as Ira was saying, we haven't really seen much effect of it yet. Will we start to see the ramifications of that in a withdrawal of liquidity from the financial system more sustainably early next year?
Can we get the yield curve up, 2s, 10s, and 30s? Because every time I check, I notice we're a little bit higher. 374 close to on a 2-year. And what are we now? 4 or 5 basis points away from the high of the year on a 10-year? After many people for the last several months, through basically the whole of summer, said the June 14th high, that was the high for the year on a 10-year. And here we are staring down the barrel of a fresh high.
Yeah, we're going to look at yield curve inversion, deep yield curve inversion, a re-inversion after a better, lesser inversion that we saw a couple weeks ago.
343, Tom.
Was this bad news? Is bad news, or was this bad news?
I think bad news is bad news on this front, without a doubt.
I will say on a math basis, people tell me interview to interview, convexity in bonds doesn't matter. I would look for acceleration in lower prices. No one believes it's there. It's a bear market.
Negative 30.
I believe price is lower.
Is that how it works?
And there's a second derivative. Everybody's going, no, bonds are different. And I'm like, okay.
It's been tough. Maybe. You've said the price loss on bonds this year, Tom.
To our listeners and viewers is tangible. They're not doing fancy pants spread market stuff.
David Kelly of JP.
They're watching the
Asset
Dow.
Management. I'm not sure David is. You can ask him.
David is,
you
but
can ask
our viewers and listeners know we're down 700 points in the swing.
They're watching the Dow, but Tom, they're allocated to...
That would be accurate. Very good.
Okay, we agree on something. There we go. Beautiful. Happy families.
Oh, yeah.
This is
joy.
Bloomberg.
Good Thanksgiving.
look, Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Live from London for our audience worldwide, this is Bloomberg Surveillance on TV and radio. We are seconds away from the opening bell. That is your opening bell in the United States of America. Equity futures going into that cash open, getting absolutely hammered. Down by 2.25% on the S&P, on the NASDAQ 100, down by almost 3%. In the FX market, a dollar a whole lot stronger, snapping back. Euro dollar just about above parity, 100.22, negative 1% on that currency pair. Yields are flying, up by 7 basis points on a 10-year to 342.73 and a 2-year through 370. You've got to go all the way back to 2007 for those kind of levels. That's the cross-asset price action with some movers at the open. Let's get to Abby. Hey, Abby.
Hey, John. Well, we do, of course, have this very risk-off day. Bearish tone for stocks at S&P 500 heading to its worst day in about 3 weeks. It has everything to do, of course, with that hot CPI report, hotter than expected. That means yields are higher, as you were just outlining. And the big key driver, the dollar, as you were just mentioning, stronger, up about 0.9%, the best day since 2 weeks. That is pressing stocks overall, but those yields higher is really weighing on big tech in particular. Apple and NVIDIA both lower, as yields higher means the valuation comes into question. But you can see JP Morgan Chase banks not benefiting from yields being higher. That's because that yield curve is coming in because the big action is on the short end, so that is really weighing on the banks overall. And then we even had a reversal in oil lower on that hot CPI print because of that dollar shooting higher. That has pushed oil lower. We also have the energy sector lower. What's so interesting about this, John, is this reaction felt knee-jerk, but it's holding on for an hour. Let's see if it makes it through the first half hour of trading or the trading day overall.
Will it stick? Abby, thank you. Bramo, if I'd said to you at the start of the year that yields would be where they are and that the Fed would get Fed funds rate to where it is and higher again next week, perhaps by 75, most people assume that's the case. Wasn't a big consensus trade to get along the financials, along the banks?
Yes, and we were talking about this yesterday, right? That this has been the trade that can't seem to work because it's accompanied by the prospect of weakness that has to be engineered by definition, particularly in the labor market, in order to achieve a decline in that inflation, and of course, the yield curve contracting.
The overwhelming consensus right now in the fund manager survey is that growth is not going to be tremendous. We can talk about that fund manager survey right now with Kaylee Lyons. Hey, Kaylee.
Hey, John, yeah, the title of this fund manager survey really says it all. They titled it Les Miserables because they call it super bearish. A record 52% of investors surveyed are underweight equities, and a record 62% are overweight cash, with cash levels moving up to about 6.1%. Global growth expectations also right around an all-time low. 72% expect a weaker economy next year, with the most people expecting a recession since May of 2020. Now, typically that level of bearishness is actually bullish, and Bank of America reads these results as a signal that the short-term pain trade is up for risk assets. Michael Hartnett saying the S&P could rise to 4,300, but he then expects the index to fall back, and he remains fundamentally and patiently bearish. As for the most crowded trades, perhaps no surprise, once again, long dollar is topping the list. 56% of investors gave that answer. That is the most extended position since long U.S. tech back in November 2020. Compare that to just 10% who answered number 2, long commodities. And you also have long ESG, short treasuries, and long growth stocks in there as well. As for the biggest tail risks, inflation, fittingly today, given that hotter than expected CPI report, is number 1, followed by hawkish central banks. Interestingly, a global recession moves this month from the number 2 spot to the number 4 spot, topped by geopolitical risk. And you also have a systemic credit event making the list as well, John.
Miserable.
Yeah.
Eddie, thank you. Just doing the English version for anyone who didn't know how to translate that. Like Tom, sometimes.
Oh my God. Is he still counting down? No,
Even better, you look like John.
Exactly.
The resemblance to Hugh Jackman is extraordinary.
Tom, on a serious note, that bearishness, does that explain the previous 4 days? And is it dated after the data point we got about an hour ago?
I would suggest it mentions to managers fighting for their careers to the end of the year. This is brutal. And again, I'm going to watch the bond space. You're going to see a breakthrough of the total return aggregates of Bloomberg, price lower. We have never seen this before.
David Kelly joins us now to talk about this, the Chief Global Strategist at JP Morgan Asset Management. David, we've given everyone the opportunity to respond to the data so far. It's about an hour old now. Your response to it?
No, it's a little warmer than expected, but I'm not going to call 0.1% of an increase in prices a hot inflation report. What's happening is it's cooling. There are just a few hot spots. There are problems in getting all of inflation to come down, but the cooling trend is there. I think markets are overreacting to this. In particular, there's a big chunk of inflation, the CPI, 32% is in shelter, and that's up 0.7%. And that's really what's driving a lot of the underlying, resilience of inflation here. But a lot of that is, owner's equivalent rent. It's a very, almost a mythical concept because nobody actually pays owner's equivalent rent. So there are parts of inflation hanging on, but I think it's really important to recognize the economy is cooling here. And a lot of the things that pushed up inflation are cooling off also. So we shouldn't get messed up by the fact that it was a little higher than consensus here. The big story here is inflation is actually coming down.
David, that is convenient for a lot of the bulls, and yet the story that people are seeing right now is that the hope was we would see a much faster disinflation that would get the Fed not perhaps raising rates as much as they were saying. How can you lean against this? What parts of the market are most overreacting from your perspective?
Well, you mentioned financials, and I think what's going on is people are assuming that this will make the Fed a bit more hawkish, and I think that's true. I mean, I think that the Fed will now have more of reason to go 75 basis points next week, and I think that's what they'll do. I think the ECB obviously just did that. I think the Bank of England will do the same. But I think the Fed will also leave the door open to a smaller increase in November, maybe 50 basis points, maybe 25 basis points in December, because what they are going to see is inflation continuing actually to cool, because that's actually what's going on. I think we'll get about 0.2% in the September read. Energy prices are going to be down month over month in September also. I think we'll see the airline fares come down a bit more. I think lodging will come down a bit more. We've got a big increase in tobacco prices. No reason why we'll get that 2 months in a row. So I just think we're overreacting to this. Yes, it wasn't good news on inflation. It was worse than expected. But the big trend here is coming down. I think financials are overreacting. I have no problem with the 10-year Treasury up near 350. I think that's that's okay. But I think the assumption that somehow we're not dealing with inflation or it's going to get worse, I think is just wrong.
What about big tech, Dave? I mean, David, we're looking right now at a 3.1% decline on the NASDAQ. It has been a knee-jerk whipsaw lower, and it has had legs. Do you push against that?
Not necessarily. I think you'd have to go stock by stock, because the issue is there were a number of things that were overvalued if you ever assumed a normal level of real interest rates. And we are getting back to a more normal level of real interest rates, and that is negative for large cap growth stocks, which were standing at very high valuations. So I do get that, and I think it's really more of a return to rationality in a lot of the pricing in markets, and that's no harm. But overall, I'm actually positive on the equity market, and I'm glad to see so many people bearish, because I think that sets us up to do a bit better over the next few months.
David Kelly, what do you see among corporate earnings? We're really before the gaming of what corporate earnings are doing, but let's get out front with you. How are corporations adapting to America's inflation?
Well, it is difficult, and last year we had a spectacular year for earnings. This year, it will be lucky if we get out with or end the year with a positive on operating earnings year over year. I think it could be negative next year. I think we're going to see an inflation or an earnings squeeze. I mean, the reality is you've got this growth in wages that is real. Companies can either pass it on or not, and I think they're going to find it hard to pass it on. And I think that's going to squeeze margins next year. So I do think that whether we have a recession or not, we could end up with negative earnings growth next year.
David, like everyone out there, on my cell phone, I have a real estate dump of whatever geography I'm looking at. Doesn't everybody go out today and mark down the price of their house for sale?
Yes, and it takes a long, long time for that market to clear. But the reality is the average mortgage payment on a new home has gone up by 60% in the last year. And that one I do really blame the Federal Reserve for. They kept rates so low for so long that it caused a prices, and now we can't deal with it. I don't think there's enough people to buy homes when you push the average mortgage rate or average mortgage payment up by 60% in a year.
John, I think this is just absolutely profound. I can't say enough about sector to sector in inflation, the different elasticities that are out there on home ownership and how it redounds over to rent multifamily nationwide. Every region's different. Guess what? This report is a game changer.
And core inflation came in hotter than expected, and shelters are one of the most stickiest part of the report when it comes to inflation. And David, I appreciate what you're saying, that things might be getting better, perhaps not worse. But when you think about what the Fed will do, not what they should do, David, can you talk to me about what you expect they will do? They've laid out their reaction function. They've told us how they'll respond to incoming information. Tell us what you think that means for what they will do.
Well, I think what they'll do is they'll go 75 basis points next week. But I do think that in the press conference and perhaps in the statement, they will acknowledge the fact that inflation has cooled somewhat, but they'll say, 2 data points are not good enough to call it a trend yet. So they'll have some caution there, but they'll put enough doubt in there to give them the space to only go 50 basis points in November. So I think they want to set it up that way. They want to put in a hawkish move, but give themselves the opportunity then to put in more dovish language without being labeled as being soft on inflation. But again, I would focus on this shelter thing. Yeah, it's a long lagging problem in inflation. But if you think about it, how does higher interest rates help deal with a shelter inflation problem? I mean, if it stops people from building houses, how are you going to bring down rents? So it's
that's the problem.
The one thing that they're most worried about, or the one thing that's keeping inflation high, is the thing that they can fix the least by pushing up interest rates.
There you go.
David Kelly of JP Morgan Asset Management is going to be sticking with us. Perhaps that's a question, Lisa, for the news conference next week. At the end of the day, they've told us the data they'll respond to. This is it. It's hotter than expected. Until they turn around and say, yes, but this is the part of the inflation report that we can't really do much about, so we're not going to do anything. That's not where we're at. That's not what they're saying.
And that's the reason why people are starting to price in a higher likelihood of a 75 basis point rate hike in November, beyond the September meeting. And this really speaks to what the Fed is probably going to signal, which is everything's still on the table. It's not coming down.
I would note in the last 20 minutes, the Bloomberg Financial Conditions Index has shown a more accommodative statistic. It's screaming that we need more rate rises out into the future.
The S&P right now is negative 2% on the NASDAQ 100. We're down 3 percentage points. We're about 12 minutes into the session. Yields are much, much higher. We had the pushback from the Federal Reserve after the rally of June into July, from mid-June into July and onto August. And then I imagine, I think we're all preparing for the pushback again at next week's meeting after the rally of the previous week or so.
Maybe in their silence, the market will start to hear the tea leaves they've been putting out there. I mean, that seems to be where we're at right now, because it seems like they won't have to guide the market anywhere if today's whole moves stick.
That's the whole point of setting out a very clearly communicated reaction function.
Yeah.
It's that you shouldn't be out there talking all the time. You just have to lay it out and say, this is it. This is how we'll respond to incoming information. What did Jonathan Gold of Credit Suisse say?
Oh, that it's game theory. I think it was something that basically they can't say that they're not going to hike rates, because then the market will become accommodative and then they won't change their goal. Yes, Tom?
If sterling goes through 114, 3-bedroom, 4-bath, Beaufort Gardens, Knightbridge.
Oh, nice.
Like $16 million.
Are we sharing that?
I think, yeah, you and I,
okay.
You're staying.
Are we on separate floors?
Of course.
Good.
By definition, it's a walk-up.
Equities down 3% on the NASDAQ 100. That's an expensive kind of walk-up, Tom. On the S&P 500, we're down more than 2%. The conversation continues. This is Bloomberg.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done. to quote-unquote revitalize Japan.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
We're seeing hopeful signs of progress on inflation as well. The price of gas, when we said what I was doing wouldn't make any difference, and guess what? It's down $1.30 since the start of the summer and continues to go down. Inflation eased in July. I said last spring that our top economic priority was to bring down inflation without giving up on all the gains American workers made last year. But there's more to do.
There's more to do, that's for sure. That was yesterday. We'll hear from the president a little bit later this afternoon after a hot CPI print. I'm sure that David Kelly disagrees with that over at JP Morgan, but most people calling this a hot CPI print in the United States of America. 20 minutes into the session, equities lower by 2% on the S&P. On the NASDAQ, we are lower by more than 3 percentage points. AMH down in D.C. Anne-Marie, we hear from the president, I believe, at 3 p.m. Eastern Time.
Yeah, that's right. And he's going to be talking about the, quote, Inflation Reduction Act. And we have a time when inflation, as you say, Jonathan, and most of the street believes, is hot right now. And it did come in worse than what was expected. And what the president has been leaning into, as you just heard him just yesterday talking about the fact that they are seeing inflation starting to quell, he's trying to lean into some of these better economic data points. The one bright spot in this report that the White House is certainly going to spin, similar to what the president said yesterday, is the fact that gasoline was above $5 a gallon in June, and right now it's hovering around $3.70. This is good news for this administration. Just last week, we had the biggest drawdown selling in the SPR since the SPR came into fruition, since we had one in its history. So this is the work they've been doing. But at the same time, how much is he really going to be able to sell this point when you have core inflation higher, when you have food higher, when you have rents higher, and the timing couldn't be worse because obviously we're less than 2 months away from the midterm elections.
Well, and we have seen 90 consecutive days of declining gasoline prices, which really is the heart of what you're talking about, Anne-Marie. But how much further can they really go? Because we were talking earlier with Regina Meyer of KPMG, and she was saying, you know, talking to how low the inventories have gotten and that they've got to start rebuilding, which will probably create the opposite effect.
Yeah, I was listening to that interview, and what her concerns are is what I'm hearing from a lot of people in the industry, which is also you need to start refilling the SPR. So that could also be good for U.S. oil companies. But I think a big question about that is at what price is the U.S. going to be willing to start buying oil, right? They would want to obviously try to fill it up at a much cheaper price. And the other big question, of course, is that this SPR release they have, and it's been a slow drip in terms of how they do the drawdowns, but it ends in October. So there's a big question of, do they slow it down into the winter, or is there going to be a potential another tap of it?
Emery Horton, thank you so much from the White House lawn this morning. On Bloomberg Radio and Bloomberg Television, we continue with David Kelly of JP Morgan. David, I want to go to my chart of the year, which is a comparison of Japan, Europe, and U.S. animal spirit, the nominal GDP. If we get a slower disinflation, if we get an elevated disinflation, how does that change the difference between real GDP and that inflation component? What does that mean for the businesses of America?
Well, I think both are going to come down. We're going to get a revision, actually, to the last 5 years of GDP data. We're going to get that at the end of this month, and it could take away one of the negative quarters we got earlier on this year. So I think growth might have been a little stronger at the start of this year, but it is slowing down. And so we're, I think over the next year, next 12 months, we'll be lucky to get 2% real GDP growth. I'd say closer to 1%, maybe add on another 3% for the GDP deflator. So you're talking about 4 to maybe a little over 4% nominal GDP growth. That's a lot less than we've been seeing, particularly in the last year. So nominal GDP growth is slowing down. What that means is lower revenue growth for companies, and that is going to be tough for companies to deal with.
Yeah.
And that's why we're seeing a lot of revenue and earnings downgrades. And we just had a note from Jonathan Golub over Credit Suisse come out and track those downgrades and how they've come in at an accelerating pace. He's still bullish. You've expressed optimism consistently, and I think that this is interesting. What's going to be, and I hate to use this word, but the pivot point for market participants to get more confidence in a rally that is not loved and clearly is quick to reverse on a day like today?
Well, I think at some stage the Federal Reserve will feel comfortable enough with the progress we're seeing on inflation and scared enough about what's going on with the economy that they'll signal that their next move is going to be less dramatic than the last move. And as soon as we go from a 75 basis point rise to a 50 basis point rise, then people will begin to figure out that this is, that the Fed's going to have to turn here. But longer term, do you think that this economy can actually operate with the federal funds rate above 4%? Because I don't. I think that longer term, there just isn't enough demand in this economy after years of very low interest rates. I think that this level of the dollar, this level of mortgage rates, they will tend to slow this economy down. So I think the Federal Reserve is going to have a very hard time holding the federal funds rate above 4% if they decide to push it there. And that's something else they have to think about. They don't want to be cutting rates next year. The market's actually pricing that in, that they're going to overshoot and have to cut. They don't want to do that, but if they go too high, then they'll have to cut next year to stop the economy from going into recession.
David Kelly, I've got one final question. You said this was an overreaction. If it is, what would you buy right now?
I think I would be a little short the U.S. dollar right now. I think the dollar is surging too much in this, and I think I would be buying financials and probably tech. I think that if long rates come down a little bit because people figure the Fed's eventually going to crack here, then I'd want to get ahead of that trade.
David Kelly, thank you, of JP Morgan Asset Management. Just leading the other way, Tom. We like that, a different view.
It was different
with an equity market
absolutely.
down 3% on the NASDAQ and down 2% on the S&P.
That was a trot down a small street in Boston from 40 years ago of David Kelly at Putnam years ago, and down the road was the legend Phil Correa of Pioneer Funds. And David channeled Mr. Correa, and trust me, John, it was Mr. Correa, where he talked about declining revenue growth given this cycle. That's what I'm watching for into earnings season into next year. The world changes when you move away from the bright lights of inflation, to borrow from Phil Correa.
An equity market that's softer, and Lisa, we've got to talk about a bond market that's softer too. Yields are much, much higher, 2s, 10s and 30s. This is quite a move off the back of this inflation report on a 2-year. Now, you can say the equity market perhaps not an overreaction because we were up 5% over the last 4 days, so maybe we're taking some of the heat out of that move. But to see yields up 17 basis points on a 2-year, 373.92 on a 2-year yield in America.
The highest level going back to November of 2007. What's coming clear is that the debate is about whether this economy can withstand 4% interest rates for long enough. And that might be one of the big, that might be one of the big dividers between bulls and bears, because people might be able to say the Fed can hold them there for longer than perhaps you think. And that is a bearish case. The bullish case is no, they can't, and they'll have to reverse course very quickly.
I think you framed that debate perfectly, not just today, but over the last several months, Lisa. Can we just say thank you to the team again for putting together this beautiful set with this absolutely beautiful backdrop here in London. We'll be here through the rest of the week. We will be here tomorrow as well.
Am I here tomorrow?
And we'll see if this equity market move sticks. You're supposed to be, Tom. On the S&P, we're down 2%. On the NASDAQ 100, we're negative 3 full percentage points. Live from a beautiful London for our audience worldwide. This is Bloomberg.
consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. Katie Fogarty crossed over from a Wall Street analyst role to steer Shake Shack through a critical transformation.
Before, it was a lot of kind of sitting in an armchair type basis. Here, it is driving a plan of how we can best maximize shareholder returns.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up